Ladies and gentlemen, and welcome to the September meeting of our September 17th meeting of the Retirement System Investment Commission. Our first order of business will be to call to order and consent agenda and adoption of the proposed agenda. May I have a motion? Second? All in favor, or are there any comments? If not, all in favor signify by saying aye.
Aye.
Aye. Any opposed? None. The motion is carried. Second, approval of the June minutes.
2 sets.
We have 2 sets. Do we have a motion?
Well, I don't have a motion because I didn't see him. I was trying to log on last night, and I don't know if it's because I have multiple emails.
No, I had
logged in.
same problem.
Right,
Yeah.
okay. So
So
I have not
do-
read them.
Do we want to
Yes, I'll continue them to the next meeting.
continue those to the next meeting? Is that, did anybody else have a problem?
I mean,
No,
I
you-
logged on to Watch Docs last night and
I-
saw some of the stuff for executive session, but I didn't see
No,
a
I had
lot of
same-
the regular
For some reason, I
business
had
stuff.
the same problem. They're okay? What do you want to do, Alan?
I'll just abstain if we got enough votes to get it through.
All right, in that case, may I have a motion to approve?
Yes, sir.
Second?
Second.
Second? No other comments? All in favor? Aye?
Aye.
Aye. Motion is carried.
And,
And with one abstention, Mr. Okay, let's move on to the next item, which is the chairman's report. And do we want to do this first? Okay. I want to recognize Herschel Harper, and let's give him an opportunity to make comments on his departure.
Thank you, Mr. Chairman. I appreciate the opportunity to address the Investment Commission. The Investment Commission, its mission, along with all the participants of the retirement system, form a unique and important partnership. As staff, we do the absolute best every day to prudently invest and manage the assets of the South Carolina retirement system on behalf of hundreds of thousands of plan participants and beneficiaries, including myself, as I too am a plan member. This is a huge responsibility and one that I take very seriously. Today, I'm submitting this communication to announce that I will be exploring other opportunities. It has been an honor to serve the Investment Commission for more than 7 years, including the last 4 years as Chief Investment Officer leading the investment team. Together, we have achieved a number of key goals important to the long-term sustainability of the plan, including building a strong investment team, institutionalizing the investment process, creating organizational stability. I recognize that the manner and the timing of such a transition is critical. And because of these efforts, I can now, in good conscience, take the opportunity to explore other endeavors. I've been asked, and I agreed, to serve as a senior advisor to the Commission, and I look forward to continuing to work with the Investment Commission, the Executive Director, and the organization. Finally, I would like to say thank you for the trust and the confidence that you have bestowed in me. It has been a privilege to serve the beneficiaries, the Commission, the organization, and the state of South Carolina as the Chief Investment Officer for the Commission. Thank you, and God bless.
Herschel, we want to thank you for your service. You've been with the commission for 7.5 years. You took over as CIO in a time of great turmoil in this organization, and through your dignified approach to the position, it's helped us to reestablish a great deal of credibility. And you've helped us build a strong investment team that has made significant strides. And we really appreciate your service to South Carolina, and we do wish you only the best in your future endeavors.
Thank you, Mr. Chairman.
Next is the chairman's report, and the first item is there is a memo in your packets presenting the proposed schedule of meetings for calendar year 2016. The schedule lists 5 meetings, including 1 possible educational retreat. As in years past, we can always schedule additional meetings if needed, and I guess we'll need a motion to approve that.
So moved.
Do we have a second? Second. Any comments? If none, all in favor?
Aye.
Aye. None opposed, the motion's carried. And then the next item is a material interest form, And I understand that Mr. Eric Nelson is going to be giving all commissioners the annual statement of material interest letter later today. The state law requires all commissioners and staff sign this letter annually. I believe that Mr. Nelson is asking all of us to return the signed form to his attention by September 30, 2015. And the next item is the Audit Committee report.
So audit committee.
Mr. Gillespie.
Obviously, as everyone knows, when was the last time we met as a full commission? June. Yeah, since the last time we met, obviously, the chief audit officer was in a serious auto accident. You know, the normal audit year runs from a month behind the regular schedule. So, because normally we look at the year-end stuff and then we set the audit plan. We did meet. We've met both by conference call and in person recently, trying to address the associated HR issues with the auto accident. We did adopt a audit plan for the upcoming year, but we're going to have another meeting later this month because there's some questions related to resourcing and budgeting given the HR related impacts. But so hopefully we'll tighten that up. Feel free to distribute that. Other items of material import, Peggy. Anything else I ought to report to the full committee from audit? Ed, anything I'm forgetting here? I mean, that's been the biggest issue that we're dealing with is, we are running behind plan. We're trying to wrap up, the open items from the prior year audit. The goal is to have those completed by the end of this month so we can, in essence, start the audit year beginning of next month. But obviously, we're trying to manage the associated, resourcing issues. And once we've got more clarity, we'll report back. But there is a preliminary approval on the audit plan, which we're happy to share. But we do expect to adjust it at our next meeting. So if you give us 2 weeks, be happy to circulate that.
And just to note that the audit plan was approved, but not the resourcing.
That's correct. Yep. But I'm hoping to get some hours and maybe have us rearrange a little bit on the audit plan as well.
Any questions for Al? If not, then we'll move on to item 4, which will be the executive director's report.
Mr. Chairman, can I ask one
Yes,
question?
go ahead.
Once before, we talked about the material interest certification, and I can't remember if we ever decided anything, but the material interest of an investment of this system, that's a substantial number. Did we ever, Robert, do you remember this conversation?
I remember
Yeah.
a couple of conversations, perhaps not with
Yeah.
you directly, but please,
Yeah.
please.
Well, if you start looking at, say, maybe a $300 million investment, well, what's material to that? That's a big number. And I think that we could be involved in about every investment there was and sign this and not be a material interest. And I know this is state law, but maybe if we could have some clarification for the commission, or we could have some type of number or some type of understanding amongst ourselves so that we could make this a number. Because I don't think anybody here is likely to have a $50 million interest in something.
I can tell you
I'm
I
not.
don't.
I can tell you. And we don't have to settle this now. We talked about it once, and I don't know if we ever got back to it. And if we could, now we got additional staff.
Is
and
that something
resources.
Eric needs to explore?
Well, I think, I think Eric in conjunction.
All right,
we
well,
can
why
look at
don't,
that.
Robert, why don't you and Eric see if you can come up with
We'll work together and
something?
see what additional guidance we can provide you.
Thank you very much.
Okay,
Yes, sir.
very good. All right, then let's move on to executive directors.
Thank you, Mr. Chairman. The first thing I would like to do is echo your sentiments in regards to Mr. Harper. I took over as executive director just a little bit over a year ago. I can't believe that it's been that length of time. And over the course of that year, I developed what I like to think is a very close working relationship with Mr. Harper. Personally, I consider him to be a friend. I certainly understand that he's kind of reached a point in time where he's wanting to explore other opportunities, but all I can say is that, and I, of course, support him in his decision, but I think that, as you said, is, echoing what you said about his taking over in a time of turmoil for the organization and his dignified approach to his position, I think is words that are well said and well put, and I will certainly miss him and his counsel. and really just would like to echo again our thanks for everything that he's done, not only for the commission, but also all of our beneficiaries. So, thank you. I wanted to give the commission somewhat of a little bit of an update on the compensation study and our progress with the compensation consultant. As the commission knows, we engaged the compensation consultant and really began studying, and they really began working in earnest in late May. That the consultant being Towers Watson, they've done a great deal of study looking at market data, really building us a custom benchmark to really to benchmark ourselves against. We've been working with them pretty well hand in glove throughout that process, we being the management staff. HRC committee met in August. Towers presented a great deal of market data and also some potential options and approaches to how we might approach compensation, especially when it comes to the investment staff and incentive compensation. At that meeting, the HRC committee agreed or really kind of set a direction for us and Towers Watson to move into when it comes to the direction that they want to see us go with compensation. So we're working with Towers Watson on finalizing a proposal. We anticipate that we'll have another HRC meeting prior to the next commission meeting. We'll hopefully have something more formal, something formal to present in the form of an actual compensation plan at the next commission meeting. So I'll be happy to.
You don't anticipate a vote of commission members?
I think it, potentially, but if there's, I would say that if there's any level of discomfort or if there's any feeling that there would need to be additional study, hopefully we would be able to give you some type of update prior to that, to something to look at. So, and if there's, obviously if the commission wanted more time to study it, then that's something that's completely understandable, so.
I do think it's important we have time to discuss it because it's far more than just nickels and dimes in somebody's pocket. We incentivize certain behavior, we disincentivize certain behavior, and if we're not careful, we end up with a perverse sense of the incentives. And I understand that there'll be a lot of work by the committee and the consultant, but I think it's something that we ought to have land here and have a bit of time to talk about it, and then perhaps vote the next
Sure,
session.
yeah. And it is it's very, as I'm sure you're aware, it's very complex trying to balance all of the priorities and obviously with the main goal of the main thrust has been to recruit and retain staff, but we also have to be good stewards of the money that we're entrusted to spend on behalf of our beneficiaries. So, and making sure that we're incentivizing the right approach to, and making sure that all of our staff aligns its mission with that of the beneficiary. So, yeah, it is a very complex set of considerations. So, also just wanted to give you an update on the Legislative Audit Council. As you're aware, we do have a draft report from LAC, which you can certainly have access to today. LAC is asking that we submit our comments and observations in regard to that report within the next 10 days. They will take our thoughts into consideration when they issue a final report, and then we will be able, of course, we'll have an opportunity to submit a management response letter, a comment letter that will also become formally part of the LAC audit. But if you have any questions about in regards to that, please let me know.
Mike, did you post that on the?
We're given the requirements of confidentiality, we can only provide paper copies. So
I see.
just
So that's available today?
that is available to the commissioners today.
Okay.
And just to echo
And don't we have to all sign? Isn't there a
yes,
sign?
there's a requirement to have the
Confidentiality.
LAC is pretty serious about the confidentiality.
All right, so
You have to sign a affidavit. So. Yeah.
Robert, do you have all those forms available?
Andrew has that for us.
Andrew?
Right.
Okay, so
Right.
Andrew, will you make sure that everybody signs that? Okay. All right, then we'll move on to the CIO's report, which, anything else?
No, that's fine. Sorry, yeah.
I'd like to recognize Mr. Harper and Ms. Bernard for their comments.
Thank you, Mr. Chairman. Today, for the investment items, we'll actually have the performance update. Ms. Bernard will begin that, and then Mr. Berg will follow up with comments for the RSIC. A little bit later, then we'll talk a little bit about asset allocation, and then we do have 3 investment recommendations that we'll discuss as well. A little bit earlier this past month, I did send out a communication to the commission with respect to the market volatility that we've experienced. And just a reminder, when you get into some of these periods, we really have to think about being long-term investors. And from its lows, we've seen a pretty good recovery, if you will, with respect to the U.S. stock market. I don't want to steal all the thunder from Ms. Bernard and Mr. Berg, so I'll stop there and turn it over to Ms. Bernard.
Thank you, Herschel. I'm going to sit down for this one. For those of you who haven't seen my attractive footwear, I'm sporting a broken foot, so we don't need to have me limping up to the front of the stage here. So normally we go after staff. As you may know, our report was intended to really wrap around the materials that they provide, so we try not to be repetitive with things that Jeff will be covering. So I will keep it very high level here. Obviously, our report is going through June 30th of 2015. A lot has happened since then. So we're going to weave in a couple of comments on what's happened since. I did want to put a little bit of market outlook in there as well, because I think a lot of people are very concerned with what is happening in the market, and is it going to continue, or are we going to see a rebound? So I'll share with you what we believe from an Aon Hewitt perspective. Obviously, there's lots of perspectives out there, but I can say that many of our views are shared pretty commonly out there. So this is basically the page that tells you everything you need to know. I'm going to dig into some of these issues, so I'll just go ahead and skip on over that. So let's talk about the major capital markets through June 30th, so the end of your fiscal year. As you can see, we did have, if you look at the second quarter and the fiscal year to date, you do see quite a bit of difference in that top set of boxes, which are the stock markets, compared to what our 3- and 5-year numbers are. So relatively flat, really, across the worldwide stock markets. Obviously, there was volatility within some of those categories, but in aggregate, we did see relatively flat numbers. And for fiscal year to date, even before the correction that we saw in August and September, we already had negative returns out of the developed markets as measured by IFA, and the emerging markets as measured by the MSCI emerging markets. Now keep in mind, these are all in dollar terms, so currency has an impact on this as well. But if we look longer term, the dominant picture in this entire page is obviously the stock market, particularly the S&P 500, at 3- and 5-year returns, and the Russell 2000, in excess of 17% annualized, which is exceptional in terms of the historical norms and what we've seen. Fixed income markets, not surprising to anyone, have been relatively flat. We did see an actual negative return out of the Barclays aggregate, which is often looked at as the broad U.S. investment grade credit and government bond index that is used by a lot of folks. And if you look outside of the United States, we were seeing some negative returns there, particularly in the emerging markets, if you look at the fiscal year to date at negative 15%. Commodities rebounded somewhat in the second quarter, but have had a horrible, horrible year to date, as prices in particular, but other commodities as well, and that's persisting over the 3- and 5-year periods. Hedge funds have earned rather anemic returns over the last year. The 3-year and 5 years are more in the 5 to 6% range, which most people expect to be kind of a norm for the hedge fund world. And then real estate has been exceptionally strong. And what we're using here is your benchmark for real estate, which is broad-based core bond funds plus 75 basis points. And you may say, why do we use that? That's a proxy for some of the additional developmental and leverage risks that's taken in value-added and opportunistic. So you have a broad range of types of real estate, and that is your benchmark. At about 14% fiscal year to date. We do not anticipate that sort of return going forward. A more normal return for the real estate markets would be somewhere in the 7 to 8% range. So that's an exceptional return that we've experienced, and you can see over the 3- and 5-year periods that has really been quite a dominant factor as well. And then finally, we show a proxy for private equity in the public markets. One thing that I think is noteworthy here is if you maybe focus on that 3-year column and look at the private equity index at 13.9, And then let's go back up to where the U.S. stock market is at 17%. It's not uncommon for public fund plan sponsors, and really all plan sponsors, to say, hey, private equity should earn some sort of incremental return over public equities. So I'm going to say we should earn over the long term public equities plus 300 basis points, let's say. In the last 3 years, in the last 5 years, that's been an exceptionally difficult benchmark to achieve. Most private equity programs have not earned 20% returns against a 17% domestic equity index. So something to keep in mind. We do think for the very long term, it is an appropriate index, but in some of these shorter term periods, particularly when the stock market's really strong, it's not really a rational index to measure your success or failure of your private equity program. We are going to be looking at asset allocation at the next meeting, and one thing I would like to do is to dig a little bit more into your private equity and the success of it against benchmarks that we use out there. Now, yes, please.
One thing I think would be very instructive to put a couple of things in perspective. Number one, when we look at the equity returns to the S&P 500 over a 5-year period, 17.3.
Yes,
In historical terms, that's, as you well know, is
exceptional.
extraordinary. I think, if I'm right, I think going back to 1926, the returns for the stock market have been somewhere on an annualized basis of 7 to 8%.
Correct.
So when you look at the returns that we've seen over the last 3 years, we're way off and not likely over a longer, much longer period of time to repeat that. That's number one. On the fixed income side, we're coming off up to this year, a 30-year bull market in bonds or rates, which in the 80s, as you know, we started out with government bonds at over 16%. And now we've dropped to a 10-year treasury, which just a week ago was down to almost 2%. So those two things need to be put in proper perspective. So when we talk about yield over on the private equity area and the 300 basis points, if you look at it in more historical terms, then the private equity returns begin to look a little more rational.
Absolutely, and thank you for raising that. I was going to talk a little bit about perspective as well, so that was a great lead-in. You're exactly right. The more long-term perspective that most folks have on the U.S. stock market, particularly in a low inflationary environment like we have right now, and honestly a pretty low growth environment worldwide, we are looking more in the 6 to 7% range, and the historical numbers are more in the 7 to 8% range. So this is fantastic. It's wonderful that we've all had that sort of a market. Our belief is that the correction that we've had through August and September has largely been a recognition that global GDP really isn't supporting this level of stock market growth. Corporate earnings globally has been relatively flat. There hasn't been expansion in margins overall globally. So in a low inflation environment, those things together really don't lend themselves to really strong bull markets. So the correction that we've had might have been catalyzed by some events in China, but really there wasn't a whole lot of new information that came out of China. Their growth had already been slowing. So the overall impact of this, we think, is a correction that needed to happen. Now, is it going to continue? Do we see things being abysmal and horrible for the stock market in the short term? We don't. There are still some good supporting factors behind the stock market. So we do see some positive returns out of it. We don't think we're on the cusp of a bear market. But we don't see anything near what we're looking at here. So just for some numbers, I wrote down what we had for quarter to date, and this is just the indices, please. So just so everybody keeps this in context, through September 15th. So these change day by day after the Fed comes out with their news today. I'm sure that'll have an effect on the markets one way or the other. But if you look at that, the U.S. stock market was down about 4% for the quarter to date. So that would be June 30th to September 15th. The non-U.S. developed markets were down about 7%. The non-U.S. emerging markets, not surprisingly, were down the worst because China's part of that, down about 16.4%, and the aggregate bond index was flat at about 0.3%. We don't have returns yet for things like real estate and private equity. They lag. They don't come out day by day. But we would anticipate that because they don't react as materially to market events in the short term, that you would see continued positive returns out of them, but more on the ilk of what we're seeing for the second quarter rather than these long-term numbers. Hedge funds earned a slightly negative return so far. It depends on how you count hedge funds, but it was much better than the stock market and a little worse than the bond market is what we've seen, which is in a down market what we generally expect. And in an up market, hedge funds should be between stocks and bonds. So that gets you a little bit of context. So what do we think is going to be happening? Please.
Well, we talked about some perspective on private equity, and I think
Yes.
what Ed said was, the chairman said was 100% correct. But when the market does either slow down or pick up, that affects private equity as well.
It does.
And so, while we have had a very good run on public equities, I think we can't ignore the correlations between the two, more than everybody thought, say, 5 years ago. The imprecise methods of reporting the rates of return, you really don't know what you've made until you exit the fund, and that's, 10 years.
Sure.
And so you can't eat those returns. You can't spend them, you can't pay benefits with them. They're
Right,
all
you can't
projected
liquidate.
private returns. And the way we quantify risk, of course, is we quantify our interest in the partnership, not the underlying portfolio companies, which could be debt laden and very sensitive to any future rate increases. So, there should be a significant premium just for being in private equity.
I agree.
Some people say the safest, Professor Ang and those guys, ought to be about 14% just to be in the game. And so, I take Ed's comments in good faith, and of course he's correct about them. I do think we have to go back to that. A lot of fees, uncertain returns, imprecise reporting, and unquantified debt.
Yeah. They're all risks that need to be taken into account. I agree with you. I think what we've seen in the private equity market, particularly since the financial crisis, is a great deal of pressure on them to write down things more quickly than they write them up. So what we do find is also a lag in them recognizing gains. So when we have a market decline, the historical behavior of private equity has been to also have a bit of a decline, but nowhere near the magnitude of the public markets, and to rebound as kind of on par with them. So we would anticipate, there's a correlation there, this shouldn't be ignored, but you're right, the long-term expected return of private equity, you should be getting somewhere in the 12 to 15% range, depending on the level of risk you take in your private equity program, the level of leverage, net of fees, net of all fees, which is the only way we look at it, to make it worth your while. And that's one of the things we'll dig into. So I think in the asset allocation review that we're going to do in November, nothing's sacred. We're going to be looking at all the asset classes and saying, hey, let's revisit our thesis behind it. Let's make sure it makes sense in the market environment we're in, and that it makes sense for your needs again. So we're going to be taking everything apart, including private equity. So that's definitely something we'll be dealing with. So in essence, we've been talking about a low expected return environment that we were anticipating, that stocks and bonds weren't going to be able to produce the level of returns that we've become accustomed to over the last decade. And this market correction is something that we think is a move toward that world. So it becomes more difficult to just achieve one's expected returns through market expected returns solely. You have to get it through manager value added. So it's not just your asset allocation, but how do you affect those asset allocations and make smart choices within your managers, minimize fees, focus on those that really are going to add some alpha. So really all those things need to be discussed when considering structure going forward. So it's a big task, but we're excited with staff to be engaged in that for the November meeting. Question on the broad markets. No, I don't know what the Fed's going to do today. So we include this always as a reminder. We're always trying to structure this around your fiduciary duty and what your statement of investment policy is suggesting that we do. So what happened that was material in our view during the quarter with your managers? The short story on these various issues are that we do not think any of them rise to the level of concern. They're by and large normal transitions or additions to staff. None of them concern us in terms of their impact on their ability to add value for you.
Suzanne, just a question on PIMCO. With all the changes
Absolutely.
that have happened with the departure of Gross from PIMCO, they had substantial outflows out of the funds, basically through the first 9 months or the first 6 months of this year. But are you satisfied that the existing management in PIMCO has been able to pick up where Gross left off? As a matter of fact, as I understand it, PIMCO Total Return Fund has had one of the better performances.
Yes. Yeah, their performances remain strong. They did have a few staff departures after Mr. Gross left. Obviously, the culture under him is a bit different than it is today. But from the folks that we've talked to that we view as leaders at PIMCO, they are very happy with the culture as it exists now. We've seen the cash flows that did go out. There were a few consultants that recommended terminations. They were largely related to that in the mutual fund world. Completely stabilized. We do have some updated numbers. I haven't looked at them in about 3 months, but we were very comfortable that everything is fine. They went from a hold on our list back to a buy. Do you remember how long ago that was, Tim?
A couple months ago.
Yeah, so several months ago. So we have already been very comfortable that everything is stable there. But thank you for asking. And obviously, the addition of Ben Bernanke we see as a very big positive and something that they've used historically when they had Alan Greenspan as one of their advisors. Other questions? Great. So asset allocation, again, relating back to the SIOP, what we always try to focus on is this last column, were you in compliance with your ranges? Here we show the allowable ranges. Here's where you were at the end of June and your policy targets. As of the end of June, there were a couple of overweights there toward core fixed income, a slight overweight, obviously within range. Other meaningful underweights were in the global and cash areas in the fixed income area, so looking a bit at core fixed income, which was a good move for the second quarter. But everything is in compliance across the board, a slight overweight to public equities. So we do look at performance, and again, your actuarially assumed rate of return is 7.5%. Here we've shown the quarter, the fiscal year to date, which is a 1-year fiscal year to date period, 3 years and 5 years. The blue bar is total fund. The policy index obviously is the more green bar. You did lag slightly by about 22 basis points net of all fees and expenses through the end of June. Fiscal year to date, however, you were up about 37 basis points or 0.37%. If we look at the longer term, you are comfortably in excess of the 7.5%, 8.8 for the 3-year and 8.9 for the 5-year. Both are comfortably in excess of your policy benchmark as well. 107 basis points excess over the 3-year and 80 basis points annualized over the 5-year periods. So this is something we always look at, and this is rankings relative to other public funds. And I know this has been a topic of discussion. We're looking at this over the 3- and 5-year periods. The blue square is where you are. The green is the policy index again. We're looking both at volatility on the vertical axis, on the horizontal axis, and return on the vertical axis. So I think what pops out at a lot of people is that you're not at the top of the return here for the 3- or the 5-year period. We'll look at rankings in just a minute. These are all public funds compiled by Bank of New York Mellon, so folks that work with them, I believe it's about 60 some odd funds on here. And they're all public funds in excess of $1 billion. So a very broad range of circumstances, risk tolerances, and needs, obviously. So one of the areas that we are going to be looking at is while you've had a much lower level of volatility than the average, it's also been achieved with a lower return. So what can we do to improve those circumstances? Looking at it in terms of just gross numbers, for the 3-year period, that puts you in the 84th percentile, and in the 5-year period in the 92nd percentile. We also show standard deviation in the middle, and higher numbers there in terms of rankings are good. So a 91st percentile means you were among the lowest risk levels there. And then on the final column, we show the risk-adjusted returns. Now you're in the 26th percentile there. So if you look at it from return efficiency per unit of risk, it's quite good. However, you can't spend low risk. You obviously would like to achieve both higher returns and a moderate level of risk. So that's one of the things that we're going to be looking at a little bit more closely, obviously, as we go forward with the November review. I did want to let you know, because universes have gotten a fair amount of discussion lately, that your second quarter rankings were in the top third of the universe. You were 31st. So I think, yes, 31st. But the 1 years were in the 80s. So the problem has been largely that you don't have as much stock as most of your brethren here in the public fund universe, that you've chosen to have a more diversified risk profile across a lot of different asset classes instead of being dominated by the stock market. the last, really, quite frankly, almost a decade has been dominated by the stock market, at least the last 8 years. So we've had very strong returns from the U.S. stock market in particular, and the less that you had in U.S. stock, quite frankly, the poorer you rank.
Do we look at volatility correctly as a measure of risk? I mean, do all other big plans, do we have a similar view of volatility? Because I always wonder that if we're not a little too conscious of it.
Yeah. So
Because of our really long range.
it's a great question. Volatility is something you have to assume to get returns. So the question is, where on the volatility spectrum do you lie? And volatility is just bounciness of returns. It's deviation away from the norm. So, you know, obviously everyone would love to have a predictable set of returns and earn that 7.5% all the time. We can't with capital markets. So what are you willing to do to bounce around that? It's one form of risk to measure. It's certainly not the only one. It is a very commonly used form of risk when one is looking at return. So from capital markets theory, most people would say that you should never look at return in isolation. It should be in construct with also looking at volatility. But it's by no means the only way to look at risk.
But it's not the bouncing around, it's not the volatility per se, it's the volatility relative to liabilities when they're smoothed out to the actuarial table that people are sensitive to.
Yep.
Right? So, I mean,
And-
the misspecification, I mean, this goes back to how much do you match, but public plans don't match asset liabilities at all, right?
Correct.
But
Much
then
more
when it comes to
corporate.
the budget, because the smoothing gets very large because they mismatched to a much larger degree, it becomes extremely painful. Whereas a normal financial institution would never run the mismatch between the assets and the asset liability mismatch in public plans is enormous in my opinion, right? And so it's not volatility per se, it's volatility relative to liabilities that ultimately creates pain when it becomes large because things are managed in a vacuum.
Absolutely. So when we're looking at after the fact returns and just trying to assess, you know, were you successful, were you not, we think you need to look at volatility and returns, okay? In a pension fund, there's no question that your ability to meet your obligations is our goal. So I'm not trying to suggest you shouldn't care what your peers do if that's all, you know, that's what you should care about, but you should be cognizant of it. You know, be aware of it. You shouldn't run your plan based on it. I agree with you completely, Alan, that liability behavior is what we're trying to get the assets to fit well. So minimizing the risk of having to increase contributions materially, how does that work with the formulas that you have all created, which are different than every other public fund? Everyone has a unique formula. How does that fit? How can we mitigate the volatility in contributions and funded status in your ability to meet your beneficiaries' needs? That's why we do those asset liability studies. So I agree with you completely. No way should you use this to set your asset allocation. However, after the fact, when you're trying to say, how was my return, you should care about the amount of volatility that you achieved to get there. So that's the only reason we're focusing on that. So when we do the asset liability studies, hopefully everyone has felt that we're not looking to minimize mean variance. We're not looking at mean variance optimization, but rather looking at how it optimizes your funded status and your actuarial circumstances.
Alan, when you refer to mismatch, are you talking about actuarial smoothing or something beyond that?
Well, it affects all those, right? But, I mean, the way it impacts the plan, like, I'll give you an example. I mean, Suzanne and I talked about this, and we did the study. Goldman did a huge study for us on it. If you look, like, our average liability is 19 years in the future, right? So take the safe portion of our assets, and we got an average life of them of about 4 years, right? And so the way to get returns up, if I have a short duration, is to raise my credit risk, right? Or do I really go out and have a fixed income portfolio that's 19 years on average, right? As that curve moves up and down, right? I mean, that's a much different, you know, portfolio there, and you wind up, you know, like, I mean, let's just take, everyone's talking about equity returns, but let's talk about what's happening in fixed income. The difference between a 19-year portfolio and a 4-year portfolio over the last 5 years is really enormous, right? So, I mean, yeah, equities are yanking around, but how you manage your fixed income can yank it around a lot, too, in that regard. The smoothing definitely plays it, right? Because, I mean, we earn, what, 885, which is above the hurdle of 8, but we're trying to amortize the dip of 08, right? So what happens when you get to your contribution calculations is you're trying to amortize a bad year in 5 years, right? But you're trying to build a portfolio built for 30 years,
Yep.
right? So your smoothing is faster than, than the portfolio that you're building, right? So again, you're sort of mismatched there in time frame. So the way you build a portfolio, and then what kind of drives them up and down, right? Salaries, inflation, for example, even within stocks, there are portfolios of stocks that have more inflation sensitivity than others, right? So you can, find a more inflation sensitive set of stocks that better matches than a portfolio of stocks that is less inflation sensitive, right? So there are other ways, even within what you do, to get better matching that can play through a portfolio in a lot of ways. I mean, Suzanne and I were talking about this. It's like,
Yeah.
take dividend paying stocks. Duration's not the right word, but they have because you're getting immediate cash flow back. If this were a bond versus growth stocks, right? Or same thing in your real estate. It's the difference of raw land and income property, right? Those have different tenors.
Yep.
About them, of return expectations, of volatility expectations, but also of cash flow matching expectations, right? And so I think a lot of things just get smooth, and that's always been the problem, is it has to balance over 30 years, but you kind of use this one number, but the reality is you got to cash flow match some along the way, because that when it all gets smoothed out, it's like, okay, if this plan got depleted, right, then years 19 through 30 are funded from the general fund, right? If this fund's not depleted, because you got more contributions and stuff coming in, then but that cash flow matching and when you actually use what pool of cash becomes important. So I think thinking through these things is important, because even within what you do in a portfolio might be different within the same asset classes, right? That there are better ways to match if what you're sensitive to is the volatility of the liability stream, right?
Yeah. Yeah, and it's obviously a concept that's been embraced very broadly in the corporate area, where their liability stream is very affected by corporate rates. So you see most corporate pension funds have moved to long-dated bonds as the vast majority of their portfolios, if they're close to fully funded, and then having some sort of return-seeking portfolio to hopefully oomph it up to fully funded and basically immunize your portfolio cash flow. Now, when you're not fully funded, it's a little trickier. It is a valid point to be looking at, how can we look at yield versus our cash flow, and how can we better match that? So that's definitely in the realm of things to be looking at. Long bonds are a little hard to get excited about right now because of the bond return environment we're in. But there's other things out there that are interesting, that have some more yield-oriented elements. One thing that I didn't mention when we were talking.
But in that argument, stocks are nothing more than a variable rate bond with a uncertain maturity, right?
Sure.
Right.
Sure.
And so they're not necessarily, and again, back to even within stocks, I think we've gone to this very high level of global stocks, but there are subsets of stocks that better match, right, what you may be trying to do.
Yeah, absolutely. So one thing, just to build on that point, within the asset classes, we think there's some interesting opportunities. So I'm not going to go into all of that for sake of time, but as an example, in the stock market, there's been a very high dispersion between growth and value stocks recently. Growth has done exceptionally well, not surprisingly. We've had this great, nice bull market. Value stocks have languished a bit. So you don't see the same amount of potential overvaluation. That lends itself to some interesting shorter-term opportunities and things that would be very supportive of a more yield-oriented environment. So there's, yield in a low-return environment is obviously something that you always like to have. So we'll be looking at that as one piece.
Just on that very point, Suzanne, I think some of the historical record shows that in a rising interest rate environment, value stocks tend to do better. So as we are moving into this period now where we will probably see some rising rates, albeit very gradually, we may be looking at a scenario where growth will not do as well.
Right.
And value stocks will.
Exactly. And then there's a whole question of inflation. Inflation's been an incredibly low at an incredibly low level. We think it's a little overly low, honestly. And obviously commodity prices dropping materially, particularly gas, has affected the inflation rates. But we do see that as something that is potentially somewhat higher, not in a high inflation environment. But inflation, all other things being equal, does pass through returns as well. So that's another positive that ultimately we'll get to a higher yielding environment in the bond market eventually, after interest rates do rise. They will at some point, maybe not today, but at some point they will. That is a positive in the long term because it gives us better rates out of bonds, but it's a little painful in the short term as we get from point A to point B. If we have a little bit of inflation come back through, we think that's a positive for several of these asset classes as well. So there's a lot of things that I think support a somewhat better environment, but still a low returning environment. Okay. So let me just quickly get through the last couple of pages here. We do have attribution for the second quarter. Just as a reminder, start over here. This is the effect that your asset allocation choices had relative to your policy. So all we're caring about here is trying to break apart those 22 basis points of underperformance. So the vast majority of it, 15 basis points, came from asset allocation. And I don't want to make it sound like that's a huge number, but it is the primary reason here. And if you look at it, it is things like, we didn't have a great fixed income return, so a slight emphasis of that resulted in a negative 5 basis points. Commodities were an area that actually did somewhat better in second quarter, but have not done well since, so it had a negative impact on you for the quarter. And then real estate, you were slightly underweighted. It was a strong performer. So this reflects, if you were underweighted in a good performing asset and you're overweighted in a poor performing asset, it would have a negative effect. Okay, clear to everyone? And then this is selection. So you had 9 negative basis points on selection, and most of that came from the public equity markets and your tactical asset allocation managers, just not doing as well in this environment. And then you can see the other areas that were positives. Flipping over to year-to-date, again, looking here first, we had a slight negative impact from asset allocation. Now, most of this is noise. There's a couple of implicit positionings that have been made, but the markets move on a day-to-day basis, so we always expect asset allocation effect to move back and forth a bit. I think what's more important here is the value added over the last 12 months. So what hurt over the last 12 months from an allocation perspective, dominated by the real estate underweight, which has been difficult in a market where real estate's been doing so well. But we're addressing that through new investments that have been made over the last quarter or so. And then here, what helped outperformance actually for the year in the global public equity and the hedge fund area also, as well as real estate and tactical. So things that didn't do as well in second quarter actually did add value for you in the year in totality. Not going to go through this, but basically all of the different composites. I know that Jeff is going to go through these in more detail, but just kind of summarizing who did what from a macro perspective, and then some disclaimers here at the end. Now, something that we usually show that is not in the report, you may have noticed, is our private market summary. We normally would have shown the fourth quarter private market summary in this. We've been going through a reconciliation process with staff. Now that they're on the Conifer system, we wanted to make sure that data was perfectly in sync. We had some very small reconciling errors on the order of a couple basis points. I didn't want to issue the report until it was really clean. So we should be able to issue that, and we'll put it on the private commissioner's website and send out an email. Shortly thereafter, the first quarter report will come out within a month or so. Within a week or so after that. It's actually all queued up. We just have to get the fourth quarter data put to bed. For those of you who know private markets, the fourth quarter data is always delayed because of auditor reports and such, so we really didn't even get that data until close to the beginning of July. So we did spend a lot of time reconciling and getting that all cleaned up, so we were exactly on par going forward. Questions? Great. And with that, I'll pass it over to Jeff.
First, I'll apologize. I've been slowly losing my voice, so I'll try to go swiftly to get through this. Thank you, Suzanne. As usual, you've done a thorough job. This is why I like to go first. You stole almost all of my points. So, lesson learned. So, one thing I want to take a quick moment, sorry, let me get my bearings here. I want to take a quick moment and talk about one of the themes for the portfolio. And we talked about this during the course of the year, but with the benefit of a little bit of perspective now that the year is over, I want to reflect on the impact of currency in our in our portfolio. So we've known the approximate impact of the currency move on our portfolio well, we know this because we know what we own and we know, generally speaking, what this impact is. But one of the things I want to do is give you a little bit of historical context for what we saw from currency during the course of the year. And in service of this, I just want to point out there's an index that is not a perfect index and it really doesn't match our portfolio, but it has the very creative name of the US dollar index. And what it tracks is the relative value of the dollar, the spot market value of the dollar, against a small basket of developed market currencies. And excuse me, I believe now that the Eurozone is sort of has a single currency. I think there are only 6 currencies in it now. But curiously, over the last 48 years, which happens to be the limit of our data set for this index, there are 48 years of data. If you line this up with our fiscal year, 24 years the dollar appreciates against foreign currencies, and 24 years those foreign currencies appreciate against the dollar. So there's this beautiful symmetry to this. But when you look for the magnitude, which, as you can see here, the dollar appreciated against foreign currencies in this index, as the index is weighted, by nearly 20%. So you think, wow, that's a meaningful move, and you start to look at some historical context for that magnitude of the move. You need to go back to 1981 to find a comparable move. So that is, by my math, 34 years. Out of the 48 years of this index, that is the only other time we've seen a move like we just saw. So I want to make sure that we all understand that what we saw is not typical, is very much atypical. It can happen, and it will happen again at some point, but it is not the norm. So I bring that up because I don't want us to, as we're going to get into in just a few moments, when we start talking about asset allocation, how we're challenging our beliefs on an array of topics, I don't want us to simply have a knee-jerk reaction to something that was meaningful, very meaningful, but it is not something that is likely to repeat itself with great regularity. So after this, I had planned on introducing performance attribution, because Suzanne covered most of what we have to talk about. And because of the amount of work that some of our colleagues spent on this, and David King and Josh Green are here in the room, and these guys deserve a lot of credit for coming up with this. They've built for us a tool that will allow us to look at performance attribution, and I'm explaining why that matters to me and to us. But this took a tremendous amount of work, and these two gentlemen need to be recognized for this. So why is performance attribution important for us as we study our own behavior and study the quality of decisions that we make? One of the things that is important to understand is at a very high level, we essentially make, to the staff, we try to influence 3 main decisions. One is, what do we believe the long-term asset allocation for the plan should be? And that's the next agenda item, so I'm not going to dwell on that. The next decision that we make is, after that is set, are there times at which it can benefit the returns of the trust to be invested differently? So can we allocate assets differently from that target allocation in order to either mitigate risk or really push return during a period where that's the appropriate perspective. And the third decision that we make, which is the most common thing for us to discuss here, relates to how we select managers and can those managers earn a return that exceeds their benchmark. So performance attribution decomposes the excess return, not the total return, the excess return. Did we add value? That's what I mean by excess return. It can be positive, it can be negative. Performance attribution decomposes the excess return into these decisions that we have to contemplate all the time. So, and I mean the second and third of those decisions. I'm punting on the strategic asset allocation decision for the time being. So the allocation effect is a term that I'll use that refers to whether or not the way that we chose to allocate assets, not the managers that we chose, but the asset classes that we chose, did we add value? And the selection effect applies that only to the selection of the managers. So Suzanne hit on this point, but I want to go slow just for a moment here, just to make sure that we're all starting from a common understanding. Suzanne pointed out that the allocation effect can be positive when one of two things happens. Either you are overweight an asset class that beats your overall benchmark. So you chose to allocate to something that was, for simplicity's sake, a winner. Or you were underweight, to continue the same language, a loser. So those are the ways that you can add value through asset allocation. More money with the winners, less money with the losers. The selection effect is positive, as I indicated, when the manager that you hire earns a return in excess of your benchmark. So let me pause here. Are there any questions?
This is all in reference to our strategic benchmark.
Yes. Yes.
And it must have been hard work. I see Davis pulled up lane.
Well, let's just say he didn't get it right the first time. No, I'm kidding. He did a great job. So, unfortunately, we're presenting this in a bright room, so the subtlety of the colors is not something easily seen. But I think you can understand the principle here. The positive effects are going to be shaded by magnitude in green, and the negative effects are going to be shaded by magnitude in red. So when we look at last year's returns from a performance attribution perspective, what do you see? At a high level, when we look at the summary data at the bottom down here, you see that we outperformed the benchmark by 39 basis points. We know that. But what wasn't clear from some of the, just picking up a performance report, is that this came entirely from our ability to select managers to outperform their benchmark. So when we look at the second column of data, the allocation effect, you can see that we haven't taken a tremendous amount of risk here. And as Herschel reminded me, the big negative is real estate. And that is simply a factor of it is, I can get hundreds of millions of dollars to work in the stock market very quickly. I can't force money into real estate. So this is something that is more structural in nature, and there's a longer lead time to get money to work in real estate. So that we refer to internally that as a structural issue, because it's not something for which we have a quick solution. Excuse me. So the standouts in this middle column on the left are emerging market debt, real estate, and commodities. Each of these is a source of underweight. In the case of real estate, that has hurt us, but in the case of emerging market debt and commodities, it's been slightly helpful. Excuse me. The composition of the selection effect, which is where our excess return has come from, is shown in the right-hand column. And I don't want to get into the details and have us mired here, but the big takeaways are hedge funds, global public equity, GTAA, and real estate have been very strong performers for us relative to their benchmarks, whereas mixed credit and global fixed income have been very much the opposite. And you know, we've addressed this. We've been taking action in the portfolio to ameliorate this problem, and I'm quite confident that those are issues that are in the rearview mirror. Private equity, I could go on at length about this. This is a situation, you know, I don't want to come across as complaining, because it's this same situation could very much cause it to appear to be outperforming meaningfully. This is the effect of a lagged benchmark. It's lagged 3 months, which has the effect of raising the benchmark by 450 basis points at this point in time. That's a random thing. It could be the other way. I'm not complaining. It's just important to understand that. I don't want to overstay my welcome on this, but I want to make sure that this is helpful to deliver you a perspective that aligns with the decisions that we make, so that you can ask better questions of us, the staff. And I want to be responsive to any questions that you may have now, but we are going to continue to try to put better, more meaningful reporting in your hands, so that you have the benefit of these as you ask us more difficult questions. Yes, sir.
Private equity on the asset class return.
Yes.
Is it reasonable to assume that you will get some significant variations over periods depending on the private equity investments, at what stage they are, and if they're early on or later on in terms of the payout and so on, so that you will get significant variations? I mean, if you had a whole bunch of investments that were in the latter stages, or that were coming due, you would get significantly higher returns than you would if you had a period when you had predominantly investments in the earlier stages. Is that
Correct.
a fair
Typically,
statement?
there's an effect called the J-curve effect, which I don't want to do charades here, but typically early on, you see negative returns because you don't have a lot of money in the ground, but you're paying fees on a committed basis. So if you make a $100 million commitment, you're paying fees on the $100 million. And then over time, those investments get made, the returns start to improve, and you tend to see back-end loaded returns. So if you have a very young private equity program, like we had probably 3 or 4 years ago, you're going to still be struggling with that J-curve effect. As our program matures, which it is maturing now, you'll start to see the returns, all else equal. I mean, I'm just using history as a guide. You see the returns rise relative to what they've been, because you have less of that fee drag, and you're now, as you indicate, harvesting more investments. Those things tend to get written up in value later stage, absent any market-driven reason why you would write them down. Private equity tends to be held at more conservative values, because you don't want to be accused of I don't know the best way to put this. I'm not a private equity guy per se, but you don't want to be accused of holding your companies at a value that exceeds that at which you sell it. Right? That's a bad practice. You do not want to be accused of that, because then you will lose the support of investors like us, consultants like HEK. Bad business. So that's not something that you would be likely to see.
The J-curve is real, we deal with it, but it's not prolonged. It's not 5 years or something. It's a much shorter period of time, and especially with the maturity of the firms we deal with. I mean, the investment period is relatively short. And so once you pop that first deal and the IRR is, with all these assumptions of all dividends will be reinvested at the same rate of return, you start getting these outsized rates of returns. And that's what shows up here. So I understand what you're saying, and I'm buying what you're selling, but I think it's this perspective about just the way the industry reports its fees. Reports its returns. And one other point here, and this is good, and this is a lot of work, and I spent a fair amount of time on this, and I liked it. I didn't know who did it, but I appreciate it. But it all comes back to the fact that our benchmark, our policy benchmark is the lowest of the 70 funds in our peer group. And that's really significant. And the fact that we're not being at that much is belies the fact of where we are. And we've got to do something about that benchmark, which of course is relative to the asset allocation, but I think it's more than that as well.
So let me calibrate one comment that you made. So the J-curve is something that lasts as long as you are building to a target, right? But as those funds become more seasoned, so as you move into years 5, 6, 7, what you really wind up with is when you have the same amount of money that you're harvesting from private equity as you're investing in private equity, that's when the J-curve is no longer any effect, let alone a meaningful effect like it is early. So I agree with your statement. Over time, it becomes a much less meaningful thing, but it really depends upon whether you're still building to a target or if you've reached that target. So I think we're saying the same thing, just differently. But to your comment on on us versus peers, I can explain very simply, and I know this to be true. We could look like our peers. If you give me 3 hours, we can look like our peers. I need to add 15% equity, and we will look and feel like a median plan. That is the biggest, and it needs to be U.S. equity. So I know the difference between us and peers, and it's something that I hope we talk about. That is the factor that we are missing in the amount that everyone else has. So, I mean, you've brought this up before. I think perhaps we're not taking enough risk, right? And that's the question I think that we need to talk about. So, I mean, we are effective with the risk we take. As Suzanne pointed out, when you look at the return per unit of risk, the question is, should we take more risk? And if so, how? So, I mean, I don't want to sound like I'm oversimplifying it, but when you look at how we are different than everyone else, and I think, Suzanne, you may have mentioned this a few minutes ago, it is the amount of equity that we have, the amount of U.S. equity we have. So, I mean, I've in recent weeks looked at what do we believe the median plan looks like. And then I had our performance guys, the same guys who made this good stuff that we have here, run this portfolio that I said, I want to know if this really is the median return portfolio. They ran it through last year for me, and it gave a return that was, I think, just a handful of basis points, different than what BNY Mellon suggests is the median return. So I have a high degree of confidence that I know precisely the ways that we're different. So it's not to say that we should do that, by the way. That's different. No, I understand.
Realize where we are, because
Yeah.
if you don't, if you're in a hole and you don't know how deep the hole is, how do you
Yep.
get out? So, again, this is good work, and it's very helpful to me.
I appreciate it.
Jeff?
Yes, sir.
Another question, private equity before you leave. I think you said our portfolio was moving towards the latter stages of maturity in private equity.
Private equity.
Having said that, is it reasonable then to assume that the asset class return of our portfolio will increase at some degree, whether it's low or modest or significantly higher over a period of time going forward?
That's a big question, and there are a lot of factors that could affect this, but all else equal, I would say yes, but I would argue the effect would be noticeable, but not
But it is likely.
earth-shattering.
But it is likely to increase. The return is,
I would say.
There's a lot of
It'll
factors.
Converge, right? I
Converge,
mean, like, if you think about the R between private equity and public equity, right? If I have a private company that's big enough to be a public company, and the public companies are paying 300 basis points more, right? Because it's more liquid and a lower discount, I'm just gonna take the sucker public, right? So that divergence between the private equity returns and public equity returns it has to converge over time, right? Doesn't necessarily mean it's gonna be higher, but it means, that's not a sustainable chart,
Oh,
right?
can we pause there for just
Yeah.
a second? So one thing, when we talk about private equity versus public equity, these are the actual returns, and, I mean, we can discuss and debate, you know, the proper way to value it, but I think on an order of magnitude, this is meaningful enough to make the point. So global public equity during, and this one was outperforming its benchmark, earned 1.8. Private equity, meaningfully underperforming its benchmark, earned 9.7. Now, we know there's a lag effect to this, but still, I mean, we're talking about assessing versus the benchmark that we've chosen. So I guess the question could be, is our private equity benchmark too high? I'm not going to make that argument because I don't think that there's no economic impact to the plan to change the benchmark, so it's not that meaningful to me. But I think when we look at the relative performance, it's important just to understand that this one's a little different. And sometimes, because there's no great benchmark for private equity, there really isn't. So do you benchmark it based upon other things you could have invested in? That's the public equity, that's what has led to this assessment that there's negative attribution there. Public equities plus 300 basis points is our benchmark. It's as good as anything, because if we weren't going to invest in private equity, we would invest in public equity, right? The goal would be to have 40% exposed to equity risk. Private is just a way to get that you think can push your returns a little bit more aggressively for a portion of that portfolio.
I think, Jeff, this is great work, and I want to compliment staff on that, the attribution summary, but I'd like to see the attribution summary also showing a comparison of where the winners and losers are with our allocation compared to our peers. I know you said,
Sure.
you know that that's in private equity, but it would help for us to see how much is in each
Sure.
one of those categories.
Sure.
As well as it's not just a question of should we take on more risk,
Yeah.
it's a question of are we spending our risk budget in the right place?
Sure, and we can get that. One thing I don't want to leave everyone with is this awe of looking at 1 year, right? This is a year, and next year will be different, and 2 years ago was different. So I don't want us to draw any judgment. It is an important exercise to go through, and we may have that. I don't know if we did that work, we discussed that, but we may have that, and maybe I can hand that to you today. So, all right, so this is simply another way of showing attribution, a bit of a more visual way, where we have the selection effect, although we probably should come up with a little more contrast between blue and gray. So, and this is a chart similar to what we've seen before, but we thought, and maybe we've fallen in love with this a little too much, but we start at what the policy return would have gotten you, and then build the bridge based upon the attribution effects to get to the actual ending value. So the policy return would have gotten you to this point, and then you look at all the decisions that we made and how do they stack up and bridge you between where a passive portfolio would have gotten you and where we wound up. So I would like to stop here, take any questions.
Does the attribution analysis help us at all with the overall policy target question, the asset allocation question?
No, what it's going to do is just given, you start from the given of these are the targets. It doesn't go back into the determination of those targets. That's actually the next topic on the agenda. And what a wonderful segue you've given us. But before we go there, are there any other questions on this? The goal here is obviously to put better information out for you as fiduciaries to challenge us and have a different kind of conversation. So hopefully that will be the fruit that it bears.
Any other questions for Jeff? Any comments?
Okay,
If not,
all right.
thank you.
You want to start?
Yeah, Mr. Chairman, I think we're about to move into a discussion on asset allocation, and just wanted to set the tone a little bit for that, if I may. I think it was probably a couple of months ago that I started using the term. Sure, yeah.
This is an important discussion, and
Yeah.
I don't want to have to hop
Yeah,
up.
let's take a 5-minute break.
I was right I was really getting into my role, yeah.
Wanna-
Yes, sir. Yeah.
We will take a 5-minute break.
Yeah.
All right, I think we can now reconvene. And Mr. Hitchcock, do you want to lead in on asset allocation?
I think I'll try to get myself geared back up to about a couple of months ago, with staff, especially the investment staff, I really started using the term challenge our conviction, because I think that that's a direction that we really need to head in, and I think that that's something that we need to do to fundamentally challenge ourselves on our asset allocation and what our portfolio looks like. I've probably said challenge conviction so many times that I'm surprised that the staff hasn't bought me a T-shirt yet that says challenge conviction. So, but to echo some of the sentiment of what Suzanne said, and I'm grateful that they've agreed to be partners with us in this exercise, and I think that their input is going to be crucial into what the task that we're going to undertake, that Mr. Berg is going to outline for you in a few minutes. I think that, to echo what she said, nothing is sacred. We're going to challenge every asset class, every percent allocation, and put folks on both sides, so have devil's advocates for every position. To the extent that the focus, at least at the staff level, unless you direct me otherwise, this will be to the exclusion of everything else that we're doing. We're not planning on bringing any investment recommendations to you in the November meeting unless there's something that is just absolutely positively necessary for us to do, because we really think that this is a good point in time for us to really take a hard look at ourselves, to be very introspective, and to figure out some ways how we feel that we can improve performance over both the short term and the long term. So without any further ado, I'll turn it over to Mr. Berg.
Thank you, Mike. I want to lay out, perhaps to call it a vision would be a little too strong, but I want to lay out a concept that I hope will resonate with you, not at all because I believe it is the answer to every problem, but because it's different and I think logical. It's a different and logical way for us to approach the establishment of our target asset allocation, the policy asset allocation. So I want to make sure up front that I'm very clear. There's no ego wrapped up in this. So I really want this to be the starting point of a discussion, an inclusive discussion. So as Mike mentioned, we're going to spend a lot of time internally challenging our beliefs on an array of topics. And I'm talking about everything. Everything from our beliefs about individual asset classes to whether or not we should have currency exposure, to whether we think hedge funds have a place in our portfolio, and whether or not we think commodities have a place in the portfolio. So we're going to look at all these issues, and we're going to do it with asking for perspective from different staff members and from HEK on all sides. So we're going to try to have somebody set up the straw man and then have somebody else try to knock him down. I think this is a way forward for us in terms of helping look at the issues from all sides. And I've asked Mike to pay particular attention to the quality of the debate and discussion on both sides, which will, I think, help us learn more about each other on the staff. So I'm going to get into more detail about that in just a moment. But also, I'd like to propose that we make a small change to the way that we think about asset allocation, the way we go about establishing our target asset allocation. So what it is I'm proposing is that we think about a starting point for our annual asset allocation process that starts from the construction of a 100-year portfolio. And what do I mean by this? Imagine that we don't come back each year and tweak the asset allocation, but instead we had to think about an asset allocation that, without the benefit of looking at it annually, would have to be the best asset allocation we thought would take us across, 10, 15 market cycles. So what does this do? This forces us to stop sort of focusing on the current environment and instead think about really what are our beliefs about different asset classes in a multi-decade sense. Because as Mr. Gillespie pointed out, that is the way that our liability stream is constructed as well. So this can give us a new starting point, but in order to create a policy asset allocation, we will still want to apply some judgment. So if you think about this, and I have a little graphic about this, but you think about that 100-year portfolio as the starting point for the discussion. And then what you do is you try to think about ways that we can look different than that 100-year portfolio over shorter periods of time based upon a framework. So that framework can involve where do we believe we are in the cycle. It can involve looking at markets and having an assumption about mean reversion. Right now, if you look at a 100-year portfolio, you would think core fixed income gets you maybe 6.5%. When in reality today, it only gets you about 2.5% prospective yield. So they're simply starting from this 100-year portfolio is not, you don't leave it there probably. You want to have a method, a framework for how you're going to then move yourself away from that 100-year portfolio. So once we determine a new asset allocation target, then what we may find is that looks very different than where we are today. And if so, then we need to have a transition map to take us from here to there. So if to continue the example from prior to the break, if we feel that we need to have 15% more equity, that's not something we do, as I mentioned, in 3 hours. That's something maybe you want to do over a period of 7 to 10 years, or anywhere in between. So if the destination portfolio looks different than where we are today, then I think we need to think about an appropriate time during which we migrate from point A to point B. Finally, at the end of the discussion here, what I'd like to do is to propose some goals for the November meeting for the discussion, which will then establish for us some goals for what we need to get accomplished between here and there. So let's talk about challenging existing beliefs. This is not an exhaustive list because as we think about things we believe in, sometimes you overlook something that is so simple. So this is a list that is much more meaningful than just what I'm showing you here. This is a representative sample, but it's probably a little less than half of what we've identified so far. So this is something, as you can see, there are lots of beliefs that are going to, what's the best way to put this? We are going to have some robust discussion and debate. There's an old saying that no conversation is more boring than the one where everyone agrees. If that's true, we certainly will not be bored. We will be having spirited discussion, and this is going to continue. This won't get done by November. We're going to have to prioritize these and think about these over time. But really, if we challenge I'm just going to choose private equity because we were just talking about that. If we ask ourselves, is private equity worth it? And we go through this exercise and we stand up and argue for and against, and we decide we do think private equity is worth it. And here's why. We've established a belief at that point, right? And that's something that I think we need to figure out the way that we take our discussion and bring it here and share both sides and share why we, as the staff, believe one thing. But ultimately, the commission is going to have to determine whether or not our beliefs should be reflected in the way that we construct the target portfolio. So I don't want to linger here because this is not an exhaustive list. These are simply representative of the types of things that we'll be asking ourselves. But are there any questions about any of these, or where I am so far in this? Okay, I'll move on. So this 100-year portfolio, let me add a little clarity to this. The way that I'd like us to approach this is to anchor ourselves in as much history as we can. I think it was Warren Buffett who had a quote. Now I may butcher it, but what we learn about history is that people don't learn from history. I don't want us to fail to learn from history. I also think that an important challenge for investors like us, because we do have a lot of information and a lot of opinion at our fingertips here. The challenge for us, I think, is to subdue a temptation to believe that over time something will be different, which is kind of maybe that's a different concept, but if we cloak ourselves in belief that the future will look like the past, I think that is an appropriate perspective. Granted, we will also identify opportunities where we feel that won't be the case, but if we establish that as the de facto starting point for our discussion, I think, and we bake that into the 100-year portfolio, I think that's a very responsible starting point for us. So as I think about this 100-year portfolio concept, I think it does two very important things for us. One, that will be where a portfolio that reflects our long-term beliefs about markets, asset classes, et cetera. And secondly, and this is something that I think is also equally important, it becomes a home base. When we don't have a compelling argument to move away from the 100-year portfolio, or we can't arrive at a consensus to do so, we don't. We go back to home base, and I think it's that simple. So as we work through this project, and we're at the starting point, this is not the end. I want to make sure that I'm clear about that. I think we're also going to want to think about how we establish ranges around any targets. I don't say this out of any eagerness to be cavalier or anything, but I think that we should contemplate whether the ranges should be wider or narrower. And I think that there should be a quantitative approach to this. And that's something that we certainly can take the lead on along with HEK. So I mentioned earlier the notion that we begin with the 100-year portfolio and we apply judgment based on a current assessment of economic environment, market environment, what have you. There are a number of ways that this can be framed, and I don't think it's best for me to sponsor any one. I think it's important for the commission to be presented an array of ways that we can do this, and that's something that I'd like to come back in November with some suggestions, rather than pushing any single idea. I think it's important that we consider an array of alternatives there.
Jeff, can I ask a question?
Yes, sir.
If our actuarial assumptions are 30 years, why are we talking about a 100-year portfolio instead of a 30-year portfolio? I'm just asking that question.
That's a great question, and I'm going to use an example that you used. 30 years ago, what were interest rates? It's been a one-way from high interest rates to low interest rates. I don't think 30 years necessarily captures a long enough period of time for certain markets to give you really a fullness of time sense of the characteristics of asset
So what you're really
classes.
talking about is trying to smooth out these periods of
Yeah, if we
Tremendous
base it,
volatility,
well, that's a great question. If we think about only a 30-year period of time, right now, we might say, over the next 30 years, we believe that that decline in rates will reverse. And that also will take 30 years. I don't know that to be the case, but I'm quite confident rates won't decline for another 30 years, right? So we need to think about, in my mind, beyond cycles to what are truly the timeless characteristics of assets and how do they interact with each other, not looking at a short period of time and not really expecting that over a 30-year period of time, I can tell you what will happen. Because I can assure you, and my wife will attest to this, I cannot tell you what will happen next week. So I think that the more we can bring in real depth to the history of these asset classes, the more it will encourage us to think beyond a cycle. And if you think, and I'm going in what I've heard referred to as the Wayback Machine right now. Bridgewater shared with us, you have these short-term cycles that essentially indicate when you go in and out of recessions. You have longer-term cycles, business cycles, and then you have this incredibly long 50-year period of time, and that is your debt cycle. So you think about the proliferation of debt right now, and I think Mr. Gillespie's brought this up. There's a long-term cycle out there, and we may be nearing the point in time now where we enter the de-levering phase of that. Think about sovereign debt, what's happened here. So there are short-term cycles, there are intermediate-term cycles. I'd like for us to think beyond that and think about the longest of long terms as we think about the characteristics of asset classes and what we think we need to construct here. And we can always move away from that when we overlay the judgment. So the little graphic here at the bottom is you start with a 100-year portfolio. You come in and you say, there are ways where I think right now we need to exercise judgment based upon economic environment, the economic outlook for the next 5 to 7 years, or market outlook based upon maybe valuations are stretched. Certainly, I think we would all agree that the fixed income valuations may be stretched now. Unlikely bonds appreciate meaningfully over a 10-year period of time from here. So you overlay your judgment on this 100-year portfolio, and that's what I'd like to explore ways that we could do that at the next meeting. And then that should help bring you to a target asset allocation that is respectful of the long term, but also you have exercise and ability to influence and overlay on that some more short-term views.
And just another component of that longer-term approach is while our amortization period might be a 30-year period or a 30-year funding period, the benefit stream lasts much longer than that. For a teacher who comes to work today and works 30 years and then receives their benefits for perhaps another 30 years, it extends, the accumulation of that money and the investment of that money spans a broader time horizon than just 30 years.
That's a very good point.
Well, I understand what you're saying, and I appreciate the intellectual conversation, but problem is, if we were a foundation, a very wealthy foundation with limited needs for, limited and predictable needs for cash, it's one thing, but we have bills to pay. And the pension side of this, y'all deal with one side. Peggy has the luxury or the burden to deal with the $3 billion payments we send out every year. We've gotten ourselves in the position where we don't have a lot of luxuries. Now, that's not to say that we can go roll the dice, but a 100-year portfolio, I've heard that term a lot recently, short-termism, all the things that you didn't hear during the 6 years of a bull market. You didn't hear any of that. It was all, I'm not talking about this group, I'm talking nationwide. You heard a lot of chest beating. Well, now, so the conversation has turned. The last couple of conferences I went to, everybody's talking about short-termism. You don't want to look to the last minute. Well, they were fine in the last 6 years. So this is the financial industry, in some ways, recasting its arguments. The problem we've got is, I think, actuarially speaking, we're at a 30-year term, and we're 29.8 years, is that correct?
Before we factor in.
Yeah,
the
before
returns
we,
for
this
previous
last year. So what we, I mean, I'll get in trouble for saying this, but contributions are gonna have to go up all around. And when we've gotten ourselves in with the current portfolio we have by being an underperformer for the last 10 years, that we have real risk in being able to pay our bills. And we can't, I don't see how we can earn our way out of it in almost any market now. So whatever we look at has got to look at this real pressure that's gonna come from the PIVA side of it. You know, people, we have, unfortunately, it's a disjointed operation. One group's worried about the bills, one group's worried about the income, and the two really don't meet, and they force each other to do certain things. Well, we're at that point where we're gonna have some force. And I don't exactly know how it falls into it. I'm sure Peggy's group, Director Boykin's group has spent a lot of time thinking about that. But we are where we are. And if we start talking about 100-year portfolios, you're talking about really long-term portfolios, we got bills we're gonna have a hard time paying next year. And that's where we are. And I think it's gonna be something we have to consider every day. It's unfortunate, but I think we should divorce ourselves completely from those concerns. Because if we can't make money, we're not gonna take that risk, but we haven't.
Let me clarify one thing. When you contemplate the 100-year portfolio, you're contemplating what portfolio do I believe will allow me to pay the bills. I mean, that's part of the characteristics of what that portfolio needs to be. So I don't know if maybe I didn't tie that in cleanly, but I mean, the 100-year portfolio needs to be the portfolio that we believe, I mean, we have the assets, right? I mean, we are going to invest them. What is the best portfolio that we believe we can create over a 100-year period of time? And it's not to say I don't mean to imply we don't check in on it, you know, I mean, that's not the point of that. I mean, we should always be debating what that 100-year portfolio looks like. But that is the portfolio you would construct in order to give yourself the best chance of success at achieving the desired rate of return, minimizing the impact on other stakeholders, taxpayers, et cetera. I mean, these are the things that, you know, I think you would need to be thoughtful of. So.
Are you gonna talk about that second square? Current market assessment?
Well, there are lots of different ways that we could
Reason I'm
seek
asking
to.
the question, it seems to me like the theoretical framework of the 100-year portfolio is great, but that the real art and key to success is how do we integrate the current market assessment
Exactly.
back to the shorter time horizon, whether it's 30 or 60 years.
Yep. Well,
But the 30 years is a sort of artificial construct of accountants and actuaries, but and to all of us, a 30-year portfolio is the same thing as a 60-year portfolio, because we'll all be dead.
well, that's what I'd like
It seems
to
to me like
come
the
back in
theoretical
November.
framework for that second square is crucial.
I agree, and I think that there are distinct paths you can go down. You can go down sort of a mean reversion path, and you assume that if equities have done well, then you would be more conservative going forward. You could think about, okay, I'm going to have an economic-based set of assumptions that are going to help influence this. You could just simply look at things that are easy to spot, like the fixed income differential. Right now, it would be very challenging for you to, over a 10-year period of time, earn, if 6.5 is the historical return on treasuries, it would be very difficult to earn that 6.5% while the treasury yields are so low, right? That requires yields to compress further. That's the only way that you earn that type of return on treasuries right now. So I think that there are several different frameworks that we could consider, and I'd like to take time in November and talk about what those would be, some ideas, and I'd like to have more time to spend with HEK to talk with them about how to, and maybe what we do is just very simply look at their 10-year forecasts and decide based upon the 100-year portfolio and what HEK is suggesting to us about the shorter term, and then come up with a portfolio that is respectful of the long-term characteristics, but also incorporates a third-party objective view. So there are lots of different ways, and you're absolutely right. That is where the art of this will be. And, you know, I'd like to have more time to explore different options, because I just don't want to push a single option. I'd like to find the solution that the commission has the most comfort with and believes is a reasonable thing to expect. A, if staff is involved, expect of staff. B, if it's consultant-driven, to expect of the consultant. And C, if it requires us, you know, there's a saying, you can't get 5 people to agree on anything. Well, we have more than 5 people. So how do we achieve a consensus, you know, without having more consternation than constructive interaction, if you will?
And Jeff, one reason I make my comments, because what bothers me, well, I was out at Pepperdine recently and asked a room full of state treasurers, CIOs, industry folks, and I asked them, Herschel, I never asked you this, but how many times is the CIO signed off on an investment plan that had more risk than he was comfortable with, but he had been given a number, a rate of return, some plans that even still are 8%. He had been given a number, or she had been given a number that they had to chase. And I think at some point, we're gonna have to have that conversation with the General Assembly. I think the directors group and this group's gonna have to look at it. Because I can't do the math in such a way that we come out of this, that we earn our way out of this. And the sooner we talk about that, the better. Last year, the scheduled negative interest, or negative amortization, which turns into interest, the amount of money that the general fund effectively borrowed from the pension fund, the scheduled amount was $530 million. Now think about that. And she's got to deal with this with her actuaries and accountants, don't have any control over it. We don't have any control over it. But as we bounce against that 30 years, they don't have any more levers, and our only lever is contributions and how we earn. And we may can take additional risk, and it may not be risk that's prudent. You know, we have people in this room that can decide that. But if we're not careful, we're gonna be bouncing up against this for years and taking inappropriate risk. And I don't want this group to be forced into that inappropriate risk because we don't have the conversations we should have. The faster we talk about the amount of negative amortization, the faster we talk about how that debt is growing, the quicker this group gets out of that risk problem. When Mark Sanford had his big summit in 2010, the unfunded liability was about $12 billion. Everybody said we'll be fine, we've got the new portfolio, we'll go right through it. It's now, the net, and this is estimated, if you count last year, is about $21 billion. $9 billion of additional debt in 5 years. Project that out, and that was through a bull market. Now we're heading to this uneasy market. Who knows where we're gonna go with it? I don't know. I count on y'all. But what I don't wanna do is, again, I'm beating the dead horse, but it's so important. We can't allow a faulty system to say, Hitchcock, you gotta go make us a lot of money. You gotta make it now. Because that's the sure way to be in worse shape than we are now. So I think that this open conversation about how bad the system really is, so that we can get the appropriate contributions and statutory relief or whatever it turns out to be, people above my pay grade decide to make, we gotta have that conversation.
Tell me again, what's the $530 million?
That's the amount of money that the unfunded liability was scheduled to raise last year if we made 7.5% and all the contributions were fine. And so, and this was about the same this year, roughly?
Probably roughly, you know,
Yeah.
there's a 10-year period, because payroll grows when you use a flat percentage of pay, to fund the benefits.
And we can be thankful that last year, our rates of return were significantly more than the assumed rate of return. We were about 15.2, 15.3, and we only had to make 7.5. We still had that charge, it just got postponed. And so I think if this commission doesn't talk about it, then PBA's not gonna talk about it, and the General Assembly's not gonna understand it. And this is a conversation just not being had. And one last thing, if we were at 29 years, you say, okay, we'll see how the market does. We're at 29.8 years before we impute the 1.6 rate of return, which is a loss of what, a couple $2 billion actuarially? Yeah.
I think we have to wait until we get the valuations
Yeah.
in December. They'll be ready and, hopefully by our meeting in December.
Good.
um,
Yeah, I
so
don't
that we
put you
can
on the spot if you
incorporate not
guess.
only the returns, but any
Yeah.
other actual gains or losses within the system for the year.
And I don't want to put you on the spot, because you've got the big job already.
Just along what you just said, Mr. Treasurer, it's my understanding that there are public pension funds all over the country, and this has been in the press over the last month or so, that are reducing their assumed rates of returns substantially. Isn't that right, Suzanne?
That's correct.
I mean, not just minuscule, but, full percentage-wise, with the exception of places like Chicago and other places that obviously have not been realistic. But what it requires is a realization and an understanding that we are in a very different kind of environment of low returns. And subsequently, it will require to be able to meet the benefits that have been promised to people that only come from two ways: increased returns or greater contributions. So that's something that, as you point out, will have to be discussed.
And there are a lot of stakeholders, so if you're talking about a school district, or a county, or a fire, public service district. The state has a lot more elasticity in its budget, these smaller districts don't. And so as the contribution rate goes up, it's gonna be a real crowding out of teacher salaries, ability to pay bonds on schools, those types of things.
Well, it's very interesting that all I can tell you is that from my own experience in Aiken, that the benefits that have been promised to city employees over a period of time are extraordinary. And when I say extraordinary, I mean extraordinary. We have city employees that will retire on six-figure pensions. I don't know how many people in the private sector will retire on six-figure pensions. But again, these were promised, and they have to be paid for.
And I believe that so much of this comes because it's not a really open conversation. The retirement systems across the country are in problems, in crisis. We're in worse shape than a lot of folks, but we're not the worst, And you can't point your finger to a single thing. But again, my fear is, I keep seeing this, it's really managed by just a handful of people. Most of the General Assembly is not aware of what goes on. It's complex, it's hard. I mean, a lot of you guys have spent half your life in school to learn these things. You can't expect a part-time guy to come in and understand it. But if we don't start talking to the General Assembly about their part, the assumed rate of return and other things, then we're setting ourselves up for a problem where this debt can consume us. Because we just can't earn our way out of it in the short term. I didn't mean to hijack the conversation, I'll get off that.
Well, and
but-
just let me say that the statute requires the actuary to conduct an experience study every 5 years. That experience study will be done as soon as they complete the valuations for this year and should be ready for the General Assembly in January. The PIBA board, in conjunction with the SPA board, will adopt the recommendations for all assumption changes outside of the assumed rate of return. That is set by statute. So the actuary will be making a recommendation to the General Assembly about the rate of return when they come back into session in January. I mean, that's required as part of the experience study.
Along the lines of engaging the General Assembly, Mr. Treasurer, I know that I and Peggy and I both have been having conversations with, with the leadership. And I understand that your point that there has to be a greater level of understanding in regards to, where we are amongst all members of the General Assembly. But I agree, and what I've been putting forward to them is that there needs to be a holistic approach to, basically an all-in approach to the system as a whole and the viability of the system as a whole. And that, they certainly have a significant part to play in that. And that we need to continually update them and keep them involved in the conversation on, especially from our side, whether or not we need to take on more risk. And they need to know that and they need to understand that because ultimately, they're the ones who are really are writing the checks. So, and ultimately it's their responsibility to make sure that the system's funded. I think that they've been very receptive to that. And, I think that that's certainly something that we could do as a combined effort of making sure that we are providing the General Assembly with that information, updating them, and making sure that they understand where we are and where we're trying to go, so.
You know, you think about like, the view they see is a jaundiced view of it. Generally, it's either the people side or the RSIC side, kind of talking at once. We gotta marry those numbers together, because when Director Boykin starts talking about the debt and contributions and things, there's not, the CIO's not sitting there saying, yeah, I don't know I can earn my way out of this. I mean, it's not your place in life to go over there and tell them that. We've gotta make sure that conversation happens, because what rate of return do we have to get us away from the 30-year bump? You know, and that's the question. And it's a lot. What rate of contribution increases do we have to get us away from the 30-year bump? It's a lot. And what we don't want to do is have that happen. So how do we get out in front of it? Because I think it's just to the point where the market's gotten where it's not going to be very good for a while, and we're bumping that 30 years just so, and we're going to probably crash through it. So either we can take the opportunity now, us get involved with it, make sure that we don't inherit the risk from the situation, and go see the General Assembly in that context, not just in the context of an agency or the two agencies.
Sure, and I think that, and along those lines, I think, Peggy and I do, when we have these meetings, we do, a lot of times we are together, and we try not to do things independently, so that we are presenting the General Assembly with the same message, especially the leadership of the committees that are responsible for that. And certainly, I think your input in that regard, and if we can all get on the same sheet of music and provide that perspective to the General Assembly, that's certainly something that I would welcome. So I think that's having that holistic approach, and really speaking a lot more with one voice rather than disjointedly is an approach that we should consider and that we should implement. So I'm with you on that.
I just want to make sure that we exhaust the discussion, because I'm effectively done. I just want to close in a.
Well, do we want to get into any sort of further discussion in terms of people's ideas? As Reynolds points out, I mean, we can talk about this 100-year portfolio, but the thrust of what will really be effective will be our current market assessments. So is that something that people want to discuss? And do they have ideas and directions we should go, or?
Let me ask this: if this is something that the commission would like for us to explore, what we have then is a clear list of objectives. We need to work with Suzanne to help define what would be a 100-year portfolio. And then we need to lay out some different frameworks for how we could involve our judgment. What I've seen before that can make this a less effective exercise is if we decide we like this, and then everyone has their own idea as to how we would overlay judgment. Right? I think there needs to be a common understanding so that we can all speak the same language related to how we approach setting the asset allocation. And I don't want to imply that there's anything wrong. I mean, what we do now is effectively the middle box, right? And the way that we do that is we rely on HEK, or Suzanne, I apologize.
It's okay, I know.
Aon Hewitt Investment Consulting, in order to help us be sort of an independent third party and hand us their assessment of what the current environment is and how that relates to how we should approach asset allocation. The question is, do we want to adopt an approach that also incorporates a longer-term historical perspective in terms of how assets behave, and therefore what is the essentially what do you earn for being an asset holder? That's essentially what the policy benchmark seeks to do for us. Is what is the compensation I expect to earn for being a holder of equity, for being a holder of core fixed income? The extent to which we can increase our returns by hiring managers to trade those assets, that's how we earn an excess return, but the benchmark simply assumes that we hold those assets. So the question that I ask is this something that the commission would like for the staff to work toward?
I would very much like to know the answer to that question. What is that?
That 100-year portfolio?
Whether we,
Yeah.
obviously that would never be the driving factor, but it has to, it seems to me like it has to be important information.
And related to that, I know we can get approximately 100 years data on stocks, bonds, and bills, but how about alternatives?
Yeah. Well, I mean, you
Do we
take,
know?
you take the longest history that you have, and so the 100 years is not necessarily, we found 100 years of history. We'll have to make assumptions about a lot of asset classes,
Yeah.
emerging market debt, things like that.
Some alternative sets are longer. Corn prices have been traded as
Yeah.
futures for a very, very, very long time, right? Real estate prices, you got history and documents on real estate going back very, very, very long time. So
Gold.
actually, more of the world was private than public, right? Because the index fund didn't come into existence until the Cowles Commission in 1957. So the private world actually has a longer history in some ways of
Maybe
when you
not-
look at
not
real
as
estate
robust
series
data.
and commodity series, much longer than public equity series, right? The modern
that's a very good
corporation
point.
is a more modern phenomenon. Right.
Jeff, I guess one of the questions that we'll have to grapple with is do we, in determining what we want as the right asset allocation, do we want to start from the generalization that we want a diversified portfolio, or are we going to become much more asset-specific? I just take an example. Obviously, it's easy to look at what happened over the recent past and try to project that into the future. That can be often a very big mistake. There was a time, I don't know if everybody's old enough to remember it, but from the mid-'60s to the early '80s, the equity markets did absolutely nothing. And I will also remind you that in 1980, in the mid-'80s, when we had the huge spike in interest rates, when Volcker, Chairman Volcker of the Federal Reserve, decided that he would put an end to inflation, he let interest rates rise to extraordinary levels, historically high levels. And this was a classic sign of a bottom in the market. The Institutional Investor magazine had a cover article, and the cover article was the death of the bond market. There will never be another bond market. It was precisely the exact time you should have been buying bonds. And I can remember institutional investors calling bonds certificates of confiscation. I think if today I told you you could have bought a government bond at 16%, you'd say, how many can I have? You would not believe at that time how many people absolutely shun them. So we don't want to make the mistake of saying, let's just take what's happened here recently and project that into the past. That would be a mistake. CalPERS, in my judgment, is jettisoning all their hedge funds. They may be doing it at precisely the wrong time. I don't know, that's again a different, but again, I guess I'm getting back to the point of, do we want to start with a proposition that we want a diversified portfolio, or are we going to become much more asset-specific in terms of our allocation? In other words, are we prepared to eliminate whole asset classes? We've added a lot. So again, this is a discussion I think we need to have.
But, I mean, I don't want to gloss over this. That's a belief. That needs to be challenged. Right? No matter whether or not I believe. I have my belief, and my belief is that we would continue to employ a diversified approach to investing, because I think that that's your greatest opportunity to reduce risk. But just because I believe it doesn't mean it's free from scrutiny and challenge. Right? So I think we need to challenge everything, no matter how sacred the belief. And I'm quoting Mike Hitchcock. You know, the sacred beliefs be the harder ones to let go, but that doesn't mean that they don't have their moment under the spotlight. So,
I think the chairman made, the treasurer made a very good point earlier in what he was focusing on income. Personally, I think that would be one of the areas that I would like to see us focus on, is what assets that we can reasonably invest in that will provide us with the maximum amount of income with reasonable amount of risk. And I think, I was discussing this with Suzanne, that I think there is a place in the portfolio for, in the equity portion of the portfolio for dividend-paying stocks. And I'm not sure that we've really, and we've discussed this. So I think that the role of dividend, high-quality dividend-paying stocks of precisely at this time, because right now with the decline of the market, the returns on high-grade blue-chip stocks are very often well in excess of 3%. And if you take that and layer that on with the historical appreciation, it would not be difficult to achieve a assumed rate of return.
that speaks to, are there ways to invest in equities that carry less risk?
Yeah.
You know, that's, some of these are not, intently focused on a belief. Some of them kind of open up the door to consider new things. But, I mean, the flavor's, I think, very consistent with your question. So if it makes sense, what I would like for us to do is, we're going to be challenging our beliefs, and, that is not something we're asking for permission to do. We're going to be doing this. But what I'd like to do is part of our November focus on matters relating to asset allocation is have come back with what staff and HEK, after considerable discussion and debate, believes that 100-year portfolio should look. And then also come back with some ideas regarding how we would consider different issues that could cause us to deviate from that. And figuring out which ways we think are appropriate for a group such as this and for a staff such as ours. So
So between now and November, we'll have so we're prepared, staff and HEK in the November meeting will be prepared to come back with a specific set of recommendations.
Along the lines of what we set as the goals.
Yes.
Right.
Yeah, and behind the scenes and things that will influence all of these, all of the asset classes, and perhaps the way that we think about this 100-year portfolio will be this robust challenging of the beliefs, but that's something that I think we'll need to figure out in conjunction with the commission how to share that, the results, the fruits of that labor with the commission. But I do think it's important that we do so. So, at any rate, I encourage feedback either now or if it's easier at a later date, or if people would like to have specific issues to make sure that we're looking at, those are that door is open. So.
Well, I would encourage everyone, if they have any further suggestions, ideas, comments between now and then, to forward them into Jeff, and we'll look forward to your recommendations.
Thank you.
We're way ahead of schedule.
Yeah. I don't think lunch is here yet, so.
So
we can
you
go
want to go
into-
ahead with these investments and
Yeah,
get
we'll
them
go
out
with
of
the
the way?
first, we can go with the first investment recommendation.
Is Wingo, if you need Wingo?
Why don't we take another like 5-minute break?
All right, we'll
Yeah.
take another
5-minute
5-minute
stretch
break
and get everybody.
Get everybody together.
But do we want to get?
Ladies and gentlemen, I think we can resume, and we'll go right into investment recommendations.
Good afternoon, and thank you for the opportunity to present. I'll be talking today about Wellington Emerging Local Debt Fund. This is an investment within our emerging market local debt portfolio. I'd like to start by thanking my colleague Ashley Aslan, who collaborated with me on the due diligence for this project, as well as our entire public markets team. This was a collaborative effort across the team. So specifically, the recommendation today is up to 4% of planned investment in Wellington Emerging Local Debt Fund. The contemplated initial allocation is $400 million to this fund. Will be structured as a commingled fund with a 55 basis point management fee and monthly liquidity. Before I begin, I'd like to start by outlining a few things I think are integral to the strategy that also are unique to the local currency EMD space. First of all, I'm going to highlight the specific differences with respect to active versus passive implementation in terms of both the risks and costs of an allocation to local currency emerging market debt. And then, of course, I'll talk about the market environment and then discuss the rationale and the analytics and the portfolio fit with respect to Wellington's emerging local debt strategy specifically. So in terms of the risk with EMD, I thought it would be appropriate to begin with an overview of the benchmarks, since the majority of our investment in the EMD space currently actually consists of passive exposure. So the benchmarks effectively describe our exposure to the asset class right now, or the majority of that exposure. What you can see is I've broken out here the benchmarks across the hard currency and the local currency asset classes. As you recall, our benchmark is a 50-50 weighting to these two benchmarks. Last time in June, when I discussed the EMD recommendations, I was talking about the hard currency portion of the portfolio, or debt that's issued in the U.S. Today I'll be talking about the local currency portion of this mandate, which is on the right side of the chart here. And there's two specific things that I'd like to highlight about the asset class before I begin here. One is that you can see there's a sharp degree of differentiation in terms of the concentration of the two benchmarks. What we can see here is that our exposure is effectively, through passive exposures, effectively represents exposure to 16 individual credits. So there's a lot more concentration risk in the local currency piece of this mandate. That's not actually representative of the entire universe of EMD. However, there's most of these countries on the left-hand side of the chart actually do also issue debt in local currency. And so when you accept passive exposure to the space, you also are by definition accepting the concentration risk inherent in the 16 countries that issue local currency debt inside the benchmark. Also, the thing I'd point out is that the local currency benchmark is a modified market cap-based weighting methodology. And what that means is that the countries that issue the most debt receive the highest weighting in the benchmark. So a passive exposure by definition entails that you have the most exposure to the countries that issue the most debt, irrespective of potentially deteriorating credit quality in those countries, without any sort of qualitative or fundamental overlay on what countries you have exposure to. So in effect, having passive exposure to the space does entail a significant level of concentration, idiosyncratic, and credit risk that can be mitigated through active management. The second aspect that I want to talk about with respect to an active versus passive mandate in the space is costs. So when you look at management fees, it's one thing, but when you look at the costs on a more inclusive basis, you would properly consider all of the costs that you would actually bear in investing in the space. And what you can see is that when you factor in all of the costs, the fees that we've actually negotiated with Wellington represents a more efficient implementation, more cost-efficient implementation of investment in the local currency space. And this investment, I think, is unique in that it defies the traditional thinking that I think exists, is that the active management is a more expensive way to access the space. For us, in this case, that's not the case. Thirdly, I'll talk about the experience of active management in local currency versus hard currency debt. What you can see here is that local currency has struggled to add value relative to what hard currency has been able to do in the space. So why has that been? One of the things you can see here is that I break out for you is the performance of hard currency debt, local currency debt, and the currency portion of local currency debt in the bottom here. What you can see is that given the local currency environment, particularly over the past 2 or 3 years, it's been a very challenging space to add value. It's been a very challenging market to add returns on an absolute basis as well. So really the keys to success in terms of outperformance over the past period in local currency debt has been as much about avoiding losses in down market cycles as it has been about adding value in up market cycles. And one of the things that's actually fortuitous about this environment is that it's given us the opportunity to view managers' returns in a wider range of economic scenarios, and in turn we think we've been able to identify a high conviction manager. So first of all, let me refresh our memory here on the asset class positioning plan that I outlined last time we talked about this. Last time in June, we dealt with a more immediate concern of effectively and more efficiently implementing within the hard currency piece of our portfolio and shifting to more active exposure. Today we're going to deal with the local currency piece of this at the bottom, and then discuss how we're shifting the portfolio to a more efficient implementation in the local currency debt space. One thing I'll stress here too, before I get into Wellington specifically, is that the effect of our recommendation today is not an increased allocation to local currency emerging market debt. Rather, it's a more efficient implementation of that emerging market debt portfolio. So again, the recommendation here is for up to 4% of plan allocation to Wellington's emerging local debt strategy, and initial contemplated allocation based on our optimization of the overall portfolio contemplates an allocation of $400 million to the strategy. The investment profile is primarily emerging market sovereign debt denominated in local currency, and Wellington does manage the currency risk to both enhance returns and reduce risk in the space. Again, the benchmark is an unhedged strategy. So the investment style for Wellington is actually very complementary, we found, with our existing portfolio, and leads to a low correlation of excess returns with the managers that we have in place and the managers that we're implementing as well. So also we think we've established a very competitive fee structure with Wellington as well.
Just a question on, this is unhedged.
But in the last bullet point there, it says the FX risk is managed to enhance returns or reduce risk. Are you confident that they are able to do that via futures or options or whatever? I mean, quite frankly, it seems to me at this point that there is still substantial risk in local currencies for a lot of different reasons. So I think we have to have a high degree of confidence that the FX risk can be managed, because the volatility in these emerging market currencies has been pretty big.
Absolutely. No, I think that's an excellent point, and I think that's something that we've spent an extraordinary amount of time focusing on through the strategy. 75% of the vol historically in EMD is actually from the currency component of that. And so that's actually the particular element that we have acquired a really high sense of conviction about Wellington's strategy with. They do have a unique approach to the currency that's driven by a rigorous and proprietary internal research process for their currency management. So one of the things that they've done is actually been able to substantially mitigate, particularly in downside scenarios. So when we look at the attribution for Wellington, we break out the currency effect of their returns. What we can see is that actually in down markets, measuring their performance across time in falling currency markets versus rising currency markets, we can see that they've outperformed roughly 80% of the time in falling currency markets versus 50% of the time in rising currency environments. So they've been able to implement a strategy that actually mitigates a substantial amount of the volatility with respect to the FX. So I dealt in extremely granular detail with that characteristic in the due diligence report. Happy to dive into that a bit more, but that's, suffice it to say that that's one of the higher conviction and more structural elements that we think will provide stable returns going forward for this strategy, and represents not only an advantage in their process, but something that's actually serves to reduce risk from the passive exposure, which is what we have now. So again, and based on their style and their unique research process, it is complementary with our portfolio too. And again, the competitive fees we would talk about. So not only is the have they demonstrated the ability to add those returns, but they've done that at a level of fees for us which represents some efficiencies. So, so to summarize our rationale here, I think it dovetails nicely with this. They've actually been able to generate, which is unique in this space, a significant level of excess returns over the benchmark, and they've done that at unique both risk and return characteristics. They've roughly doubled the return of the benchmark, and they've not done that at any significant additional volatility to the benchmark. So the reason for that, in part, is driven by their rigorous proprietary research focus. The team has nearly as many quantitative and sovereign economists as they do portfolio management professionals. So we think that's driven a significant amount of their thematic strategies that have been implemented successfully. And lastly, diversification. So this portfolio, we don't just look at this in isolation. We have a talented risk team here, and we've created, of course, the correlation matrix of this across the other exposures in our portfolio. And this also fits very nicely into the other exposures that we have and demonstrates a low correlation of excess returns. So in terms of what they've done, the results for Wellington here, I demonstrate on the two right-hand charts. What we can see is that they've roughly doubled the returns of the market since inception of the strategy. They've outperformed on a 3, 5, and 7-year basis at a significant level. And they've done that without using leverage. So this is an unlevered strategy. They've managed to outperform significantly, and they've done that at a significant, at essentially the same level of volatility as the benchmark. So those are extremely attractive characteristics for us in terms of the strategy, we feel. And in terms of the correlation of their excess returns with what we have in the portfolio here, what I'll demonstrate is the correlation of the key piece of active management that's going to constitute the bulk of our hard currency portfolio. So what we've done is we've assessed the correlations of excess returns on a 1-year rolling basis with what we have in the existing portfolio. And what we see is that over time that's been roughly 0.19, and they've tended to demonstrate relatively low correlations, particularly at times that have been attractive for us, and particularly at the times that you would like to see lower correlation of returns based on their differentiated approach. So it dovetails nicely with the existing approaches in our portfolio and allows us to, on a blended basis, achieve a more efficient implementation of the EMD portfolio than we otherwise would. So in terms of considerations, as with any investment, there's certainly considerations that we want to be cognizant of and we want to explain clearly here. One, the team did experience a significant departure in April of 2013. Mr. Ricardo Adrogué, former lead PM for the strategy, did leave in April of 2013. We spent a lot of time with the firm and getting comfortable with what they've done since then and how they've managed that transition. One of the things we found is that we do find a significant consistency, actually, of leadership throughout. Jim Vallone, who actually is the lead PM for the strategy today, actually launched the strategy and was the PM for the strategy in the first 2 years. He also, in early 2009, he was promoted to be co-director of the global fixed income allocation for Wellington, and then relinquished the lead PM role to Ricardo Adrogué, who led it until his departure in 2013. Once Ricardo left, Jim Vallone was able to seamlessly relinquish his duties as co-director of Wellington's global fixed income platform and reassume his leadership with the EMD team. Throughout that time, he also did maintain his status as head of the overall EMD team, including several other strategies within EMD. We think he is critical to the strategy, and his leadership has been consistent throughout. Also, the team has continued to perform, and we think, based on what's been demonstrated in the processes since then, we do have conviction that what they're doing is going to be stable throughout. So anyway, we've gotten comfortable with that. The other element is that one of the things you'll notice is that the local EMD space has been challenging, obviously, over the past period, over the review period here for Wellington, especially. We do want to be cognizant of that and say that while the returns for Wellington have been very attractive on a relative basis, on an absolute basis, obviously the returns have been something less than what you would expect from the local currency asset class. So that's something we do want to be aware of. Of course, we also want to remember too that we're looking at long-term time frame here, and we don't want to be overly influenced by the past 2 years, which has been very challenging for the space. That being said, Wellington has demonstrated an ability to add value in a difficult market environment. And we think it's actually been good for us to be able to sort of identify characteristics in their strategy in both up and down markets that are attractive. And lastly, of course, we've already pointed out that passive exposure in the space can be both more costly and more risky than active exposure. So with that, the recommendation that I have today is for up to 4% of the planned investment, initial contemplated allocation, $400 million, and of course, commingled fund structure and 55 bips, management fee, and monthly liquidity for us. I'll open it up for questions at this point.
Did you cover leverage? I got to read
I did, yeah. I
You
did, yeah,
just-
no
just
leverage
like-
in this account.
No leverage, good. On the 55 basis points is up to 25% additional for administration, right? And then the portfolio firms or other investments can have their same. Is there contribution redemption?
No contribution or redemption fees for this investment.
And there's a comment in there about monthly liquidity unless they need a longer term. Is there a limit to the longer term, how long they can throw a gate up?
There, in terms of gating, there's not, obviously they have fiduciary responsibility to their investors in this strategy, and they've never gated in the past. We've spent some time on this. They've not done that, and keep in mind strategy was launched pre-global financial crisis, so they went through that period without ever having to utilize any of those functions. So that's given us some confidence around their use of that. These are relatively liquid securities in here. When I say monthly liquidity, notice period is on the 22nd of every month. NAV date is at the end of the month. So that's the time period in which you would expect to be redeemed.
And one last, I noticed the Aon has a qualified, why were they qualified?
Sure. Primarily because of the portfolio manager turnover. We had a supplemental memo that we also included in the packet that gives the rationale behind why we are comfortable proceeding. One of the key reasons, sorry, I'm gonna steal your thunder, Tim. He was gonna do this. But one of the key reasons is we really do think they're a leader in emerging market debt platforms. So it also gives you some flexibility in the future as well to products that may not be open necessarily today, but could offer some very good work there. We're comfortable with the existing portfolio manager. We just haven't
Yeah,
rewritten it.
I read your memo about
Yes.
what you said, but it never told us why it was qualified. But
It's purely the portfolio manager turnover that occurred in 2013.
And the SEC review, is that ongoing or?
Yeah, no, so there's an inquiry. It's a broad-based inquiry over the entire firm. Wellington manages $913 billion in assets as of right now. This strategy is $11 billion. This is a broad firm-level inquiry that the SEC opened. As with any SEC inquiry, there's not a huge amount of granular detail that they're gonna give you. I think there's a couple things that do serve to mitigate that for us in this fund. One, the liquidity of the assets. Obviously, we have monthly liquidity, as I mentioned. So in terms of any extreme adverse scenario, you have that, and you also have. It's very unlikely that this would, any Wellington-specific issue, if it were to arise, would create any issue with the valuation of the underlying assets that they own.
Is it of concern to you that Wellington doesn't have any skin in the game in this fund?
So I think Wellington is a private firm. They're made up of 155 partners that actually own equity in the firm. To say they don't have skin in the game, I would caution against really thinking that. So the PM for the strategy is a partner in the firm, and so he has significant. I think he does have certainly significant skin in the game. A significant part of their compensation structure as investment professionals too is also tied to the performance of the strategy. So I think that there's to say they don't have skin in the game isn't quite the case here. So that's something that we're certainly cognizant of. Obviously, our continued relationship with them is dependent on, extremely reliant on their performance. So I think they're very incentivized to perform.
have any questions for James? Any further comments? Well, if not, then, Mr. Hutchcock, do you want to read the motion?
Yes, sir. The motion in regards to Wellington would be, one, adopt the recommendation of the CIO and the Internal Investment Committee as set forth in the summary terms chart on page 1 of the due diligence report dated September 17, 2015, regarding Wellington Trust Company, NA's CTF Emerging Local Debt Portfolio. 2, authorize an investment of up to 4% of planned assets into the CTF Emerging Local Debt Portfolio with an anticipated initial investment of $400 million. 3, authorize the chairman or his designee to negotiate and execute any necessary documents to implement the investment as approved by the commission. 1, upon documented approval for legal sufficiency by RSIC Legal, and 2, upon expiration of the 3 business day review period as approved by the commission on May 1st, 2014, or as may be amended or suspended by the commission. 4, authorize the chairman and/or the CIO or their designees to thereafter authorize the custodian of funds to transfer such funds as are necessary to meet the obligations of the South Carolina Retirement Systems Trust funds with respect to the investment.
Is there a motion to approve this investment?
So moved.
And do we have a second?
Second.
Second. Any further comments or discussion? Hearing none, all those in favor, please signify by saying aye.
Aye.
Aye. Opposed? None. Motion is, investment is approved.
Mr. Chairman, lunch is here, so my.
You want to break for lunch?
Yes, sir.
All right, we will now break for lunch. Zoom, Eric, you have the floor.
Are we all set? Okay, I've got two funds I'm recommending today. The first one is Crow Holdings Realty Partners 7. This would be a $100 million commitment. This one here, the management fees are outside of the commitment, so we're also asking for a very conservative additional $15 million for management fees. The number is probably actually going to be more in the range of half that, but we just wanted to be very conservative and put that out there. So you'll be approving actually both amounts. This is a value-add real estate fund. Estimated total commitments between 1.3 and 1.5 billion. Move that, sorry. Targeting a 10 to 11% net IRR, investing in multifamily, retail, industrial, and hotels and office. Geographically diversified across the U.S. Average of about 50 investments per fund. The key fund terms are 4-year investment period, discounted management fees at 1.25% versus fund fees at base fund fees at 1.5%, a 9% preferred return, and 50-50 catch-up. And Aon Hewitt rates this fund as a buy. A little background on Crow. Crow Holdings Capital Real Estate is a Dallas-based firm. They've got 62 total professionals. They invest primarily in the U.S. We'll do some in Canada, and they can go up to 10% in other regions. They are basically an equity manager. They've done a little bit of debt. Talk about this a little in future slides. They were established in 1998 to manage Crow Holding Capital's real estate fund business. Their roots actually are traced back to 1948 when Trammell Crow started developing assets in Dallas, so they have a very long history. And they've invested about total about $3.7 billion so far. There is 6 members of senior members on the investment committee, averaging 29 years of experience, 23 years together working at Crow, so a very long history. Again, 62 employees, 47 in the investment staff. They're structured basically having teams across the different property types. They have a senior member as the team leader for each group, and then they'd have their senior and junior analysts below that. They have a very strong analyst program. They hire from the colleges each year, and they put them through a good training program, and ultimately they will potentially float up into those various teams. Their main philosophy, the philosophy they've held in basically all their funds, is to target what they call cash flow-oriented investments. These would be, assets, multifamily, retail, industrial. These are assets that are less dependent on the exit value. They have more stable cash flows and then less capital costs also. They will put in, so they're targeting 70% plus for that, and another 30% into office and hotels. The past 2 funds have basically been 80% plus in the cash flow-oriented investments. The next few slides, I'm going to take a look at their diversification across both property type and geography, and then also compare them to our two value-add managers, TA Realty and Greystar, as we believe this, this fund will be a complement to them. So, looking at this slide, you can see that Crow has had an emphasis in multifamily and retail, though they are diversified across the other property types here. TA Realty, on the other hand, has been heavy into office and industrial, and then Greystar is a multifamily specialist. So we do believe Crow will be a complement to them from that. This map here just shows their prior three funds and where they've invested. They look for growth markets, primarily, of course, in the Sun Belt and the coastal regions. And this slide is same as the one before, except we're looking at geography. Again, basically investing in the U.S. You can see that Crow is invested heavy in the Southwest, 30% of the portfolio. Have been well diversified otherwise. That is primarily Texas. Or that is Texas, basically. I mean, this is a Texas manager. They have their roots in Texas, so that's not really a surprise. On the other hand, when you look at both TA and Greystar, they're heavy into the Pacific region, which is California and Oregon and Washington. So again, we feel like it's a diversifier against our current existing two managers. This slide take just a minute to kind of set up. What we've got here is we've got property type across the funds, the different vintages. And what we've got highlighted here is kind of their approach as they enter into a fund. They have a top-down approach where they're looking at opportunities in the market. These are basically three highlighted, targeted investments that they've made and they've done well on. So just briefly kind of go through these. In the yellow, in Fund 2, is 44% of that fund went to retail shopping centers. That was 21 shopping centers. And I'm not sure if you remember, it's basically at the time when internet shopping, everybody was afraid internet shopping was going to take over bricks and mortar real estate. And so they felt that was overblown. They invested in 21 centers. They ended up getting almost a 2 times multiple on those assets versus a Fund 2 assets, a gross of 1.69. So it did well. The second is the red here. 20%, and as you note, it's really just that fund where they did this. Was in Fund 5. They saw an opportunity with the big major oil companies divesting their convenience and gas stations. They worked with some operators. They provided them mezzanine debt, and they purchased assets in that space. They did very well there, 2.15 gross multiple, whereas the Fund 5 total gross was 1.7. And then finally, up here in the green, basically the last two funds, they've taken advantage of the housing crisis where multifamily assets were in high demand. They've done very well, had good rent growth, and so they've invested heavy into that, over 50%. This is Crow's performance track record. $3.7 billion invested across 6 prior funds. As of 3/31/2015, about 90% realized on Funds 1 through 5, which is what I'm going to focus on this slide. Fund 6 is a relatively new vintage, so a lot of those assets are still held at cost. They've been achieve across the first 5 funds nearly 12% net IRR and a 1.4 multiple.
Can I ask a question here?
Yeah, sure.
Fund 1 and 2.
1 and 2. Yeah.
10 years from 98 would have been 2008?
Mm-hmm.
And they hadn't closed the fund yet?
No, they will. Well, there is some. Yeah, there is some.
And then there's 2000, so that's, so what we talked about earlier, these internal rates of returns and all of these measurements are extremely imprecise. These funds haven't closed and there's assets still waiting to be disposed of. And presumably there's a reason why they haven't disposed of the asset.
Yes, I believe those, you can see it's a very small NAV. The really fund that they have predominantly is 4, which is the one that they had trouble with. That was the one as a 2006, 2007 vintage, and I'll talk about that. But yeah, some of those assets they're still working through because they, basically when you get into that recession, everything does stretch out. But typically their fund, are shorter period. Their whole period for an asset is about 3 years. And that particular fund, Fund 4, now you're talking about Fund 1 is $10 million, in terms of what's left in there.
Yeah, but until it's closed out, we're unable to receive a compound rate of return. We still have to rely on IRRs and things which aren't accurate. I mean, did I already tell the story? When I was at Pepperdine, we asked who had seen a compound rate of return when it exited private equity? And nobody had seen one. And these rates of return, you can't spend them, they're not accurate, they're imprecise, and we gotta quit talking like there's something,
Yeah,
because they're nothing.
I'm not sure that I would agree with that, because it's, one, it's been realized, and it's probably been, 98%
Which
realized
one?
for a very long time, so.
Yeah, but
if-
as long as you're dealing with IRR, you're dealing with all the complexities of assuming that all the dividends were reinvested where they were or not, and that they were at the same rate of return as the beginning investments. I mean,
I think another measure that's important is to consider not only the IRR.
Is the
we understand
multiple,
that, it's not a perfect measure, but also understand the distributions received back and the multiple and capital invested
Right.
is an important metric as well.
it is, Herschel, but from 98 to now, that's 17 years. And so 1.4 for 5 years is wonderful. 1.4 for 17 years ain't great. Yeah.
So,
Yeah.
but as far as what you can eat argument, is you understand the actual capital you've gotten back.
Yeah.
And so that helps you understand the cash flow dynamic.
Yeah, and I do understand what you're saying. But we make these decisions repeatedly based on these numbers, and these numbers are imprecise. And again, Suzanne was helpful. She said she would go back and see if we have closed out funds and try to give us an actual exited fund. You know, we used to have in our annual report that they don't like to report on private equity because until you exit the fund, it's not precise. Well, we took that out of our annual report. And now we treat these numbers as if they're sacrosanct, and they're not.
Well, I mean, we look at both numbers. We also tend to try to focus on realized assets. I mean, when we analyze these funds, we're looking at many different facets.
Yeah, and then, excuse me,
so-
one last time, I'll be quiet, because everybody knows what I'm saying about it. I got 6 funds here, and you've told them at the bottom, the net IRR for 11.8, that's absolutely a worthless number. I mean, it gives you, you aggregated different years, different strategies, and come up with a number. And it's incomplete. Some of these funds are, 6 months old? 12, 15? 12, 15's not here yet, is it? Oh, it was-
No, 2012 is when it
2012.
started investing, yeah.
What's the 15-year?
That's when it's basically, the investment period is stopped.
Oh, 15 years?
Yeah, no, 2015, so it's
Oh,
a
I'm
three-year
sorry.
investment.
Well, yeah.
These are 3 to
Apart.
4 year investment periods,
Okay.
each one of them.
But,
And that's why I say that even the 98 one, I understand what you're saying about the IRR, but, without having the data in front of me, that fund was invested between those 3 periods, 98, 99, and 2000. And being that this manager is only going to hold an investment for 3 years, yes, it still got $10 million, but that's, again, they probably had most of the distributions occur just like any other fund fairly, quickly. And so those IRRs are based on that particular time period of when it distributed through.
what interests me the most is the exited investments. And that's the one thing as a fiduciary, I can't find any fiduciary in any plan in the country that's ever seen a private equity rate of return on an exited fund.
Well, the problem is, and I'll get to another screen, they've sold 194 assets out of 310. So I'm not a private equity guy, so I'm not going to go down that path. But basically, for real estate, especially with this manager, they have a lot of realizations. So we're basing a lot of stuff off, of course, realizations. Yeah. I mean, with the manager who hasn't done a lot of realizations, we tend to be nervous. Then we've got to really look into them. But these guys have had a ton. And they've had good, and that's one of my future slides, you'll see that they've, I think it's a 1.7 multiple. So we look at both, okay? We don't, we try not to look at just IRR, we look at multiple. 1.4 multiple is good for a value add manager. It's a little bit on the lower end because they do tend to and you'll see it in a future slide, they will have, let's say, a 3-year investment thesis of getting through an asset. At the end of that time, when the value creation has occurred, then they sell the asset. So they're not holding these assets very long. And that's why they're a little lower on the multiple than we expect for a value add manager. But a value add manager between 1.4 and 1.6 multiple, that's what we're looking for. But we also looking for an IRR. Now you can see that their IRRs, though, they've actually achieved a lot higher IRRs. The problem with when you do the 1 through 5 is you're capturing this particular fund that did poorly, which every manager in real estate, or basically every manager in real estate in 2006 and 07 did bad. So, that's basically an average between, those first 5 funds, including Fund 4. So,
Well, every investment no matter what we did today, if we completely 100% change that portfolio, in 5 years, 10 years, 15 years, there's gonna be a wonderful reason why it wasn't successful. You know, right now, we're talking about how currency, the currencies, we're out of bounds with that. 10 years ago, 2008, was Lehman. Who knew that was coming? You know, 3 or 4 years after that, who knew that we were gonna have quantitative easing and the effects that it had? Everybody got that wrong. I mean, there's gonna be a reason why every one of those numbers can be easily and softly and explained away if they go south. And I just think we have to have, and I think the industry's moving there, we have to have better ways to know what these funds are actually making this fund and what our real risk is. So thanks.
Sure.
I think when you step back too, I think we focus on realizations, but I would always argue pension plans, there's too much of that activity, right? Where you wind up putting fees, it's a portfolio turnover issue. So like take that fund one, you were able to sell all the good things and then you're left with the stub of the bad thing, right? Wouldn't you rather have kept all the good things as well, right? Along the way, and not have recycled the capital and paid another set of fees along the way, right? So one of it is if you can construct a good long-term portfolio, you ought to stay with it, right? You have to do some pruning around the edges, but effectively this way, like if all our real estate money was in this, it'd be turning over every 3 or 4 years, right? Seems high for a real estate asset class, right?
Well, closed-end funds.
Right.
You know, Eric spent a lot of time last year on developing the separate account implementation with several managers. So I think that actually really addresses that point of thinking about holding assets that are really good assets for a much longer hold period and not having to be forced to liquidate just because of a fund term. And so I think the commission has taken steps to implement differently within real estate and think differently as well. So I think that really addresses that point, and that's, I think will be favorable in the future.
Yeah, we're trying to move more in that direction, but definitely as a closed-end fund, you're gonna find, their term, 3-year investment period, 10-year term, that's pretty typical. So, I think, again, that's a small amount there. I don't have that exact thing of what that is. But you can tell the rest of them have all been realized, and basically that's been realized too. So, those returns, to us, seem fine, so. Let me continue here. This is their strategy. They basically have 3 strategies, really primarily 2 that they've used. They're a value-add manager, so value-add acquisitions would make sense. They've also done about 14% development across their funds, though there have been funds where they've done up to 30. They're projecting to do 25 to 30 in the Fund 7. And then the 4% for the mezzanine debt is basically the gas stations and the convenience marts. And they did that mainly because they wanted that protection from debt. So they didn't do equity in that particular investment. But you can see it's been predominantly value add. They've, based on here, you can see down here, a 1.6 on the value add gross multiple. And that's basically buying assets and increasing NOI through increasing rents, increasing occupancies, reducing expenses. They'll reposition assets. They like to invest, of course, in recovering markets, and they like to buy below replacement cost in markets where they can show, or they can see that price appreciation has occurred in those submarkets and there's high barrier to entry. So that would be their strategy for the value add. And then new development. Here I want to just kind of mention this because this is something we had to look at. You can see that development of 1.3, that's actually skewed heavily because of the performance in Fund 4, which I'll get into a little bit more. But in essence, all the assets in Fund 4, both development and acquisitions, did about the same. They'll be basically return of capital. And so development didn't do any worse than the acquisitions. It was a very bad time. Values dropped 40%. In the 07 recession, the late 1980s, early 90s only dropped like 15%. So this was a very tough recession, especially for a value add manager. But outside of Fund 4, they've got basically a 2 times multiple on their development. And they are a development firm. That's where their history comes from. So they'll be looking to do up to 25 to 30%, primarily multifamily, which I think is a good time for that. And they like it because of the type of asset it is, and then a little bit of industrial.
Eric, just on that first bullet point, mezzanine debt investments.
Yeah.
Where they have convenience and gas stations, are those separate freestanding items, or are they talking convenience? And most convenience stores have a gas station, not all of them.
Yeah,
But
these
gas
were-
stations, freestanding gas stations, at least from what I've thought over the years, is they were not terribly profitable.
No, the actual play here was, they were finding the best assets on the best corners. And so they became more of a real estate play as opposed to just, buying the gas station. The operators were finding assets in, like in Brooklyn or, New York, where they were on really good real estate corners. And so they were buying them, I think most part, they were like a mobile, with a mobile store and mobile gas,
Yeah.
basically what you're seeing out there today. It's just that they could pick them up at a cheap price because the oil companies, basically now, I think what I remember is about 1% is what they own now, but they owned more then, and they divested out of them. So these guys were able to take advantage of that opportunity. They do see it today, again, same opportunity, but it's with the operators. The ones that bought those assets need to expand and buy more, and so they may potentially do 5 or 10% in the Fund 7. But it was more of a real estate play than it was just buying the gas stations and stuff, and the convenience store. So moving on to, basically just stratified the gross TVPI, into different buckets to kind of see where they've been able to achieve it. I'm again going to focus on realized assets, which we like to do because we know what they performed as, and we're not necessarily dealing with what could be a too high of a unrealized value. So we do tend to like to look at those from to see if they really do what they say they're going to do. Looking at that, we have 71% of the gross TVPIs are above 1.5, and only 11% are below 1. So they've consistently added value over time across their funds. This table here shows their quartile ranking versus the Burgess Value Add Universe. And as you can see, funds 3, 4, and 5 have been first quartile performers versus their peers, and second first here in net TVPIs, and that kind of goes back to what I was telling Treasurer Loftus, is that they do tend to sell a little quicker than maybe their peers, and so you're going to have a little bit lower multiples, but still very good multiples. And then Fund 4 is the one, talk just a little bit more about, I think I've already kind of talked about it, is their one that underperformed, but as you know, they are first quartile performers in both IRR and TVPI against their peers. So, that was a very tough vintage, but they still outperformed their peers. This is the public market equivalent PME analysis that we've kind of started to do. This is against the Odyssey benchmark. This is an index of 30 core real estate open-end commingled funds. I know we talked about that later last year. So basically how the manager performed against a core real estate index. On average, you can see across their funds, first 5 funds, they've been able to achieve 520 basis points above Odyssey and a 0.2 multiple above Odyssey also. The investment strengths, the rationale behind why we like this manager, is successful track record, 6 prior funds, 17 years investing. There is going to be a significant, and there's been a significant investment by Crow Family Holdings, which owns the company, and of $100 million. And they'll be treated just like any other LP in the fund, which is very unusual, actually. They've had, just like I mentioned before, we've had significant realizations, 194 out of 310, a 1.7 multiple. Very experienced senior management. They've been working together for a very long time. Averaged 29 years professional experience, 23 years working together. They have capabilities across the country, both geographically and property type. And they've proven, at least in certain times, that they can be very opportunistic, and they look out and see what's in the market, and they take advantage of it, and they've done well with that. And finally, they're a complement to our 2 existing value add managers. You mentioned the Crow Family Trust to be treated like everybody else, but when you read and hear about the
Co-investments, they're not treated like everybody else. I mean, these specific co-investments, will permit the Crow Family Holdings or an affiliate of the general partner to acquire the entirety of such co-investment at the closing of such pending, of such offering. It's after they have let all the LPs bid on it, or see to get in, Crow can come in and just buy the whole thing.
No, I don't believe that. I think what they do is
That's
if
what it
they,
says.
if they want to use their capital to do it, in the meantime, they can spread it out to the investors afterwards. I think that's what they're doing. Sometimes you'll find managers, they move quick because they have the capital to do it, and then they will offer it to the investors once they've purchased the asset. So I think that's what that is. But when I say they're held, they're treated as, first of all, they're not getting assets that's not offered to the fund. So that's not going to happen. They basically, the reason they set this whole thing up was that Crow they're a real estate company, and they wanted to diversify their holdings. You know, they're a fairly wealthy family. They wanted to diversify their holdings. So what they did is they created two entities. This entity, which basically will do all the funds business and their fund investing, their real estate fund investing for their family. And also they set up another investment partnership that does other types of investments. And so that between the two, they're getting a diversified portfolio for their family holdings. And that's where the $100 million is coming from. But they own everything. So in terms of them getting access to any deal, they're not. They have some assets that they own currently that are not part of any fund, and they owned them, and they've owned them for a long time, and they'll continue to hold them. And these guys have nothing to do with those assets. So in terms of co-investments that would go to the family, not going to happen. Now, what I was saying, though, is they're treated as an LP. They pay management fees and they pay promote, just like LPs do, which is unusual for, especially for such a large manager, $100 million.
Well, I would just respectfully disagree. I think it's just like the Brookfield initial investments that we didn't understand. These are complex documents, and I can only read what's here.
Right.
And I don't believe that's what it says. So,
Right.
thank you, Eric.
Yeah, sure. So I've got three considerations I want to talk about. We talked already kind of about it. It's the Fund 4 underperformance. Again, you saw that they were a first quartile performer even in that vintage. That was a tough vintage for everybody, especially value, because value-add managers need to be able to increase rents and occupancies and so forth. If demand drops off like it did in 2006 or basically 2008, you're going to have troubles, and they all did. But these guys outperformed everybody. Part of that was, they did put a third into development. It was actually in their minds that was a good time for development, but when everything stopped, you've got assets you got to work through, and that's also why they're holding those assets, because they're still working through some. Some had debt on it they needed to keep, and then so there is, which is to be expected. Probably a lot of our funds have done that. The second consideration is the fund size, and really that was just staffing in terms of sufficient staffing. They moving from a fund that's about $1 billion to anywhere between $1.3 billion and $1.5 billion is where they'll end up. They tend to hire every year. They keep track of their assets to professional ratio, which has been about 2 to 2.5, and it's going to stay there. They're hiring about another 8 individuals this year out of the colleges. They put them through their training program, and they move up into some of them will move up into their teams. So that hasn't been a problem. They've kept that ratio pretty consistent. And then finally is development, and we talked about that already. This is a development company. They've been developing stuff since 1948, so they know development. They also have 2 entities that they don't necessarily work with because they decided they didn't want any kind of conflict, but they have an industrial developer and a multifamily developer that's right in their offices they can talk to. But they don't use them for their development. They use third parties for their development. So that was just a decision that they made, and it's probably a good one for just no conflicts. So they've done very well on their development outside of Fund 4. So in summary, the firm had a long, successful track record across 6 funds. They've been able to adapt to the market changes and see the opportunities and take advantage of them. And there's a discounted management fee for us of 1.25% versus the fund at 1.5%. So therefore, I recommend a $100 million commitment to Crow with the additional $15 million above that for management fees, which again is a very conservative number, but we wanted to be very conservative. And open for any questions or more questions.
No further questions, comments? If not, Mr. Hitchcock, do you want to read the motion?
Yes, sir. In regards to Crow Holdings Realty Partners Fund 7, 1, adopt the recommendation of the CIO and the Internal Investment Committee as set forth in the summary returns chart on page 1 of the due diligence report dated September 17, 2015, regarding Crow Holdings Realty Partners Fund 7, authorize a commitment not to exceed $100 million into Crow Holdings Realty Partners Fund 7, representing capital commitment applied to investments management fees to be built outside of the committee capital. Authorize the chairman or his designee to negotiate and execute any necessary documents to implement the investment as approved by the commission. 1, upon document approval for legal sufficiency by RSIC Legal, and 2, upon expiration of 3 business day review period as approved by the commission on May 1st, 2014, or as otherwise amended or superseded by the commission. And 4, authorize the chairman and/or the CIO or their designees to thereafter authorize the custodian of funds to transfer such funds as are necessary to meet the obligations of the South Carolina Retirement Systems Trust Funds with respect to the investment.
May I have a motion to approve? Second?
Further
Do we have a second?
Yeah, second.
Oh, any discussion?
Just in light of that discussion, because it's in that document, but that document is in our confidential thing, can you give me a page number? I'd just like to look at that real fast before we vote, just to make sure I understand the.
No, I can't because I had an excerpt. Oh, well, maybe I can. Co-investments, page 46 and 50 through 57.
Of the contract, you think? Okay.
Yeah, the
It'd be
LPA.
in here, yeah.
Yeah, co-investments and joint ventures.
And of course, you guys will get a chance to look at the documents afterwards, so, we'll want to check on that, but that's not my understanding, that's what would happen.
Well, and you go through here, I mean, the thing that the most clear about is that every time they turn, they or their affiliates are able to charge fees, and they want everybody to know that. And, everybody's got to make a living, don't get me wrong. But we look at our portfolio and we don't make any money. And then we wonder why. These are incredibly complex documents. And when they're making these decisions, we're not there to litigate those decisions. When all their affiliates are charging these portfolio funds fees, we're not there. And so at the end of the day, when we look at our rates of returns, it's like, well, what happened? I think a lot of it is just these agreements are so complex that nobody really understands.
Yeah, I do want to say that their fee is management fee and of course operating expenses, but they're not charging other fees other than the carried interest if they perform. So I'm not sure they're not using any of their affiliates to in essence they could have, like I was mentioning before, they could have used their development groups to do their development, but they've decided that's too much conflict and it's just easier. They use outside sources for that. So they have them as a resource, which is really helpful because they're experts in their field, but in terms of
Affiliates the general
fees.
partner shall be entitled to receive fees from third parties where such affiliates function as the managers of such joint ventures. Affiliate. I mean, I don't know how many times we have to go through this. But, let's just go ahead and vote because it doesn't matter. We don't have a way to quantify this ahead of time. And by aggregating all of these disparate strategies and investments, it's nonsense. It's meaningless. And so what we're doing is we're going to sign another contract. We have no idea what the fees are going to cost us. We don't have an accurate way to determine how much money they've been making because of the way it's done. I mean, if you turn that stuff into a sophomore finance class, they say, you can't do it that way. It's only the industry has been able to project this out on everybody else. In the 3 conferences I went to this year, I made special attention to go to difficult ones. One about which way everybody asked about you, or I don't know where you were. They missed you from last year. There's a sea change out there. Private equity knows they've got to change the way they're doing business. They admit it in public. The CIOs and the treasurers and everybody else is saying the same thing. We're just going to, we have this conveyor belt going, and we can't sign enough of these deals, and then we're going to say, we're going to change the way we do business. These are only 3 or 4 years, and I'm glad about that, but some of them are 10 years. And then they hope to liquidate the expenses. So anyway, beating a dead horse, I'll be quiet, but if you read this LPA, you wouldn't sign it with your own money. And that's the problem we have.
Well, is this a problem unique to this investment, or is this an industry problem? From what you say, it's an industry problem.
In Pepperdine, I had 3 private equity guys on the panel. And I've learned I've learned you never ask questions in private. Because in private, they tell you anything you want. They're all smarter than I am. Ask them in private with smart people in the room. They couldn't answer any of the questions. Every single person, professor from North Carolina, finance professor, Ashby Raines from out in Sanford, they're all incensed. They couldn't answer the questions. And it's these kinds of questions. Nobody can quantify them. And the way they have presented this, especially the aggregation of disparate strategies over different vintage years, and think that that's meaningful to us, it's like going to the remember the old field days at high school? And you got the first graders and the fifth graders and they're all running races, and you throw them all together and think that it's meaningful by how fast they ran and who won and all that. Anyway, I'm not going to change anybody's mind on this, and I don't have illusions, but I just got to get off my chest, and I've done it. Not me if I say it again. I'm counting on you, Suzanne.
Well, Eric, just as a matter of interest in prior real estate investments that have had similar indentures or similar agreements, when you've have you had at the end of or close to the end of these things, have you been able to get any kind of a handle on the aggregate fees?
Well, first of all, we ask them, we always ask them what kind of fees they're getting. That's one of the important things is we try to find out what fees can you take. Because they do, some do. Some have affiliates they're using. For example, some have their own property management group, so they're paying themselves property management fees because they're using them for property management fees. Some of the little more, private equity-like investment managers, maybe they'll be sitting on a board or something and they'll get a fee for that. And in most cases, that'll be shared with the fund. Sometimes it's not shared 100% with the fund. But typically, that's rare, especially with a manager like these. I mean, these guys, in terms of some of the language there, I don't know. But, that's definitely a question we ask them. What fees can you get outside of the management fee and the promote? And I need to know, and that's what we ask them. If they start giving us fees that we feel like they're feeing us to death, then we rethink the strategy or we don't invest with them. I mean, it is something high on our list.
But when you ask them a question, they will respond to you that they've gotten fees from other than what they've disclosed?
They better not lie to me, I'll tell you that.
These are prospective conversations, and also the fees are much easier to quantify and identify than expenses. And when you get into the affiliates, just pretend, well, say when Blackstone bought Hilton. Blackstone in their contract, I don't like Blackstone, I'm not talking about Blackstone. Blackstone had the ability to use its real estate firms, use its appraisers, lend itself the money, to borrow money from itself, to remodel all of those things they could do through affiliates or portfolio companies. And it says in every one of these contracts, for clarity, to make sure there's no mistake about it, there is no conflict of interest when we deal with our portfolio firms. And there were firms up there, Eric, there were funds that were closed out. Why didn't we get a final compound rate of return, like the Bank of New York or Jeff or David or these guys could do for us? The industry doesn't want that out there. And when you look at some of the groundbreaking work that's been done in places like Stanford and Boston College, and you look at the amount of fees, the amount of expenses, and the actual rate of return and the exited business funds, it's not nearly worth the risk. And you didn't hit me.
I won't hit you, but keep in mind that compounded rate of returns work great when you have the same amount of assets invested over the entire investment period. One of the reasons we use internal rates of return, and it's not magic, it's because you start out that assets are drawn down, so you have a little bit of assets at the beginning, a lot in the middle, and a little at the end. So if you just equal weighted those, that would not be a good representation of your actual return.
Yeah, I used actual cash flows.
Yeah, local
Okay.
cash flows.
So I
But you
used
have to have the
actual
exited
cash flows.
And the
I have-
compound may have simplified it.
No, I have cash flows for every fund, all the way through. I summed those together for first 5 funds, and I calculated an IRR and a multiple,
Yeah,
basically.
some of them together is a big problem. That goes back to the first and fifth graders running together.
But that's how I did it. It
moderates
wasn't based on
everything.
any weighting or
Can I make a
anything.
comment maybe and interject here? I think that a lot of the topics that were brought up are very important and things that the commission needs to really consider and think about with respect to allocating to private assets, whether real estate, private debt, private equity. Understanding the agreements and so on and so forth. All things are very valid points to be able to understand that. And this is something very big in the industry. We as an organization have been on the forefront of trying to understand all the total impact of fees and expenses.
Yep.
And So I would say that let's have this conversation. I think there's a November meeting to talk about these issues. And that could be a topic to be isolated to that meeting, if you will, to go through as a body, is the commission still comfortable with investing in private equity? And I know that private equity, and when you start reading through the documents, there's a lot of language in there that we do need to think about and interpret. But also, what you need to understand is if you take a look at a public company that's traded, and you go through their financials, can you really get as much transparency as to affiliated transactions and so on and so forth? So I would not want for anyone to think that these affiliated transactions can be absolutely isolated to only private equity. They could be happening in public companies as well. But it really gets back to, one, if you're making a private investment, you're giving up liquidity. Two, who are you investing with? Do you have confidence in those managers that they're going to have high ethics and high standards, and they are going to be completely transparent and give you the information that you want? And do you believe that these managers have actually been able to demonstrate, net of all fees and transactions costs, the ability to actually deliver higher returns better than you could have achieved in public markets? And so I think those are all very valid discussion points for a November meeting as you think about challenging convictions. And do you think these asset classes still make sense?
Well,
So-
I just think, your last point, at the risk of oversimplification, at the end of the day, when you close one of these private investments out, whether it's real estate, private equity, whatever, what was your return relative, you put X in and you took Y out. What was your return? Was it sufficient enough to overcome the difficulties of trying to identify what some treasurer has objected to in terms of the difficulty in identifying fees? Are those returns superior to what we might have achieved in other asset classes, and are they really helping us? That, again, that may be an oversimplification, but that's much easier for me to understand.
I think that's a great comparison, but then of the opportunity cost.
Yeah, well, that's part of the question, but I think the other part to the treasurer's question, again, I'm a little hesitant to talk about the specifics. I don't know if we need to go in executive session, because this stuff all has confidential stamped on it, right? So I'm a little hesitant over here, so I don't know. You can, maybe some guidance before I step on a landmine or something?
Well,
To
talk about the
specifics.
specifics,
Yeah,
if we're
specifics,
gonna
that way
get to
you-
the specifics,
yeah, that way you can
specifics
be-
of the investment, absolutely.
That way you can be more,
Absolutely.
you can feel more unrestrained.
Yeah.
That we can have a more
Yeah, I mean, it's
unrestrained
because
conversation.
what some of
Yeah.
these questions go to this PPM, that go to some other issues that, but the PPM has confidential stamped all over it, so I don't wanna talk about it too much.
Do you wanna do that? You wanna do that now, or you wanna just, basically, because I would assume
Well,
that we
do
would
we
run
wanna-
into the same
Yeah, I mean,
types
do
of
we
issues in
wanna-
the very next
Yeah,
investment.
so some of these are very common, but some of these also are kinda unique, because some of the issues are not unique, but the way they're solved in a partnership document do become unique, and that's what's got confidential stamped all over it, right?
Get into the specifics that are,
I mean, I think we're
considered
I think we're at that point, so I think the decision is, and maybe go ahead and pre-game any of those types of issues that may be, for the next investment.
Right.
So before we vote, so I think maybe we just go ahead and do that. We'll go in executive session now.
All right, then, if we want to have that discussion,
Yeah.
we'll need a motion to go into executive session.
I'll make a motion.
Second?
And and Mr. Chairman, the basis of that motion for this executive session, I would present would be, or I would suggest would be to discuss investment matters pursuant to SC Code Section 9-16-80 and 9-16-320.
All in favor?
Aye.
Any opposed? I think the treasurer is opposed.
No, I'm sorry.
Oh.
I'm sorry.
All right, so it's, all right, so it's unanimous, so we will go into executive session. Who would,
Are
who,
we just planning to do all the executive session at one time, or just
No,
about this
I think
investment?
let's-
You broke it up.
Yeah, I kind of broke it up, so,
I
yeah.
think we'll just talk about this.
Yeah.
so we're just gonna talk about this.
I mean, we can, I can amend the, to do all of it.
Why, we would come back into
If you don't want to, if the thought is not.
session for
Well, we've got another,
Well, we have an open motion right now, because we motioned to approve this with a second, so that's still open and on the floor.
Right, so-
So we at least have to come back out
And
at
deal
some
with that.
point and deal with that.
Right,
because
and
we've
you've
got
got
an
to
open
deal with
motion.
and we have another investment behind it, so.
So you just want to deal with this one?
I think we deal with this one and then.
All right.
And then come back, and then
Yeah,
come
come
back.
back.
Again,
and then
just
go
because
back.
we're in the middle of a motion,
Yeah,
otherwise we have a.
Yeah, let's not, yeah.
So we will go, well, we,
All right, Reynolds just gave us an out. He just motioned to table the motion till after executive session. That way we can talk about all of it in executive session and then come back out. That probably makes more sense.
all right, so where
Yes.
are we?
All right,
So I'll second Reynolds' motion to table the motion.
Right, and then, so we would need to add to that also to discuss personnel matters pursuant to SC Code Section 30-4-70.
Well, we gotta deal with the current motion first, which is the approval. We have the
Right.
motion to approve the investment, which Reynolds just motioned that we
Well,
table, so
actually-
we can get it off the floor.
Not to be overly, we actually had, the motion pending was to go into executive session, so
Right.
you'd have to, theoretically, you gotta.
I gotta withdraw.
Yeah, you gotta
So I'll
withdraw, right.
unwind that one to entertain Reynolds'
So we're
motion.
withdrawing the motion to go
To
into
into
executive session.
And now we're dealing with the motion to table the motion related to the approval of the,
All right, so we need a motion to approve,
To
to vote on Reynolds' motion?
right,
Right.
correct,
All right, all in favor of
tabling.
tabling the motion,
Ah,
signify by saying aye.
Aye.
Aye, opposed,
all right.
none, it's unanimous.
Now we can have the motion to
Now
go
we have a
into executive
renewed
session.
motion to go into executive session, which, and I'll read the bases again, which would be to discuss investment matters pursuant to SC Code Section 9-16-80 and 9-16-320, to discuss personnel matters pursuant to SC Code Section 30-4-70A1, and to receive legal advice from counsel pursuant to SC Code Section 30-4-70A2.
So
We would need,
I'll make the motion.
and a second.
Second.
Okay, we have a motion and a second. Any discussion? If not, all those in favor signify by saying aye.
Aye.
Aye, opposed?
we would need, for this discussion, I would recommend we would have me, Herschel, Wingo, Scott Wingo, Eric, yeah, and Burke, Jeff Burke, yeah. And everybody else we would, yeah, legal, of course, yeah, legal. Legal most always has an input.
Legal's like fixture.
Yeah.
All right, Mr. Hitchcock.
Thank you, Mr. Chairman. There's 3 motions for your consideration coming out of executive session. We can take these one at a time. The first motion would be that the commission ratifies the executive director's recommendation of Mr. Jeffrey Berg as the RIC's acting chief investment officer, the effective date being October 1st, 2015.
Motion to approve? Second?
Second.
All in favor? Aye.
Okay?
It's unanimous.
The next motion would be that in regards to the conducting of a national search for a permanent chief investment officer, that the commission delegates to the executive director and staff all responsibility and authority necessary to provide for the procurement of a national search firm and selecting the search firm in order to conduct the national search.
So
Mo-
moved.
Motion to approve, second?
Second.
All in favor?
Aye.
Aye. It's unanimous.
The third would be the commission approves all other personnel and investment matters that were discussed in executive session and directs the executive director and other necessary parties to take all actions necessary to implement these decisions as approved by the commission.
Motion to approve?
So moved.
Second? All in favor?
Aye.
All right.
It's unanimous.
Now, Mr. Chairman, we also have the 2 motions remaining in regards to the 2 investments. It's my understanding that there was a thought that because the motions are in the packet, that we would waive the reading of those. So that the first would be the motion in regards to, in the packet, in regards to Crow Realty Partner Fund 7.
Is there a motion to approve?
So moved.
Second?
Second.
Any discussion? If not, all in favor?
Aye.
Aye, opposed? How did I know?
The last item would be the motion in the packet in regards to Torchlight Debt Opportunity Fund. And again, the motion is in the packet.
Motion to approve. Second. Any further discussion? If not, all in favor? Aye. Opposed? Okay, 5-1.
All right? And that would be the only thing that we would need at this point, Mr. Chairman, would be a motion to adjourn.
You going to announce that since everybody's back?
Oh, yes.
Do we want to, before we adjourn, you wanted to say that, or can we, are we adjourned?
Well, we can just say, Mr. Chairman, if the commission would like to take a moment to recognize Mr. Jeffrey Berg, and take a moment to congratulate him as an appointment as acting chief investment officer.
Motion to adjourn, second? All in favor? Aye. We are adjourned.
We can't call